5.17, total cost of revenue 79.43, and gross profit 49.25% as of quarter 3, which is going to be the most recent quarter. So one thing I want to look at here too. So look at this quarter 2, total revenue 45% at 131 mil, and then quarter 3 was 156 mil. So as you can see, sales are literally only increasing year after year after year after year. Even year-wise, we could see 2023 we did 389.60 mil. 2024 we did 390.23 mil. Okay, so not only are each quarterly sector getting better each time, and the chart is looking ready for a bell curve, it's having some promising revenue. So Intel, okay, this is going to be one I'm up a lot on right now. I'm going to close that. So Intel right here, okay, I'm going to go ahead and close some Intel at around all-time highs up here. Then I'll go ahead and I'll sell like 90% up here. Okay, as soon as all-time highs gets hit. So one thing about the market, I know that market is always wanting to chase all-time highs. Okay, market is going to always want to get back into all-time highs. So always remember that. That's the whole goal of the stock market, just like I talk about all the time. These companies run the whole infrastructure of America. Google, Microsoft, NVIDIA, these are globally used companies. America has a lot of CEOs that they create. And when we are able to invest in these companies are able to put more income into their business so they can have more factories, and then more employees would also equal more taxes being paid as well too. Okay, so you have to keep that all in mind. So this is going to go ahead and be the Intel trade I'm currently up on right now. I got it at around $35 a share, $33 a share at around this higher low here. So what I went ahead and did is I hopped on my monthly here. I looked from left to right so I could see it open in from the 80s. Price decided to progress, go up, go down, go up, go down. So I saw we were able to get past this strong area of resistance here from 2000, which I really, really like, which I could see we're headed back up to right now. Once we pass this, we should be able to break and head up to the all-time highs at around 62.70 area up here. So I'm looking to go ahead and just catch this for the whole entire ride up. So, right here, catching the rest of this trade up here. Okay, so just the whole remainder from where current price is right here to this resistance up here is literally just profit waiting. Okay. And then you can go ahead and set alerts here too. And that's what I like to do is set alerts. You could do it like unlimited if you want. Okay, and then you could include overnight and extended. Boom. Okay. And then from there, I could save that if I wanted to. Okay, or you can make it once per minute. And then I could save that. Now, when Intel decides to go ahead and hit up here, I'm going to go ahead and get triggered an alert. And all I can do is grind in real life, keep adding shares, keep adding shares, keep adding shares until price decides to come back to this area up here. At this all-time highs up here, price still has room to progress forward. Within this whole shaded box is whole just profit room waiting to be made. Okay, so that's going to go ahead and be Intel. That's why I got in right here at around this higher lows. As you can see, I bought in after this weekly candle or monthly candle. Price started to come up from down here. Then the US decided to do like the deal, if I'm not mistaken, with the AI chips. So putting news with the chart is really, really important too. Then after that, price decided to burst up, create those mini resistance, come down, make this low, come up, come down again, made a higher low. After I saw this higher low got put in, got on my daily, I saw 2 to 6 green daily candlesticks going in an upwards direction. So I know the support is going to be true. I have the support candle here, and then I have 1, 2, 3 green daily candlesticks after that. That lets me know that buying is definitely for real. So I like to look for 2 to 6 green daily candlesticks after a support wick. And as you can see, buying was confirmed, and we have price just heading straight up back to the original all-time highs of 62.70. So that's why I got into Intel there. Let's talk about IONQ. Currently up on this a little bit. Here, up on my daily. IONQ got in at around $49.13 a share. And looks like we're headed back up to that $84.64 a share at that all-time highs. And that's really just what we want to be waiting for. I saw this low over here. Price came up, came down, made this low right here. Price came up, came down, made this low. And then we have 1, 2 green daily candlesticks. But then after this support, we have 1, 2, 3 green daily candlesticks. Even just 2 green daily candlesticks after the first support wick. I went ahead and bought there, and I could see that price was at a discount and looking to go ahead and just fill in the rest of this area here. Okay, catch the rest of this profit, wait for the money to make itself. Okay, so you want to buy low, sell high. Buy low, sell high. Okay, if you guys are struggling with buying low and selling high, head over to stackmode.net, and I want to show you guys how you can do that. Okay, EOS, energy stock that I bought into. Bought this at around $14.22 a share. Currently up some profit. I'm going to pull up the monthly for you guys here. Monthly, all-time highs IPO'd at 31.95. And then we also have this little area of resistance here at 19.91. So same thing with this here. I'm going to close at the 32 area up here when it's at all-time highs. Go ahead and trim, cycle in the next wave, and continue to just refarm. Okay. So even right here, financials, quarters seem to be improving. Okay, so from this quarter here, we did $10 million. Then the next quarter did $15 million. Next quarter did $30 million. I like that a lot. So EOS is making money. IONQ, definitely big quarterly increases here. Went from 7 million to 20 million. Huge jump. Then after that went to 40 million about. Huge jump. Very, very profitable. Intel 2, we're starting to see some tiny increases. 12.67 billion one quarter. 12.86 billion one quarter. And then the really big increase, 2.78% the next quarter. So 13.65 billion. Go. NVTS, still waiting for this. This is going to be an NVIDIA stock here. So this is something that I'm going to be just waiting on here. Revenue has been going down when it comes to NVTS, but I do believe in this. It's a partnership stock, and I think it definitely has some nice room to rally, especially as more news starts coming into play. So this is what the chart looks like here. We blasted an IPO to 22.19, and we just recently came to this resistance at the 17.82. Right after this sell-off, I decided to go ahead and buy this higher low due to the fact that it's just literally some profit just waiting for us. So went ahead and decided to buy that higher low there. After this area of support, we got 1, 2, 3 green daily candlesticks. I like that a lot. I know we're going to go ahead and shoot right back up to that 22.19 area of resistance right here. So I think this is a clean area for me to buy. Close at all-time highs, current all-time highs, and I'll go ahead and cycle. Path, waiting for Path. Path could be a huge stock that people are going to be holding for a minute. Right now, we're going to be headed towards this area right here. This area of resistance at 27.79. So waiting for this to go up here. So with Path, on my weekly, I saw we IPO'd all the way up there. Price came down, made this area of support here. Had a lot of buying after that. Multiple green daily candlesticks. Then after that, price came down. Made another higher low. Came down, made another higher low. Okay, so after this higher low was made, lots of buying. And it looks like another recent higher low is just put in here. Let me go to my daily. Okay, so after this support candle, we have 1, 2, 3 green daily candlesticks. It looks like it's searching for a new low, waiting for another push up, and looks like we're going to be catching Path upwards too, at least to this 27.79. And then, you know, over time, it'll go ahead and continue to trickle and do its thing. So yeah, that's going to go ahead and be the portfolio. Just slam, you know, slamming. This is what I just wanted to cover. Just wanted to show you guys what I'm getting in, how I've been making gains this whole year. This number is very bad, so don't forget that. But yeah, just wanted to show you guys the gains I've been making this year, the progress that's been being made, and just the performance. Check this out right here. You're going to be able to see my performance against the S&P 500. So I'm up 6%. S&P 500 is 1.45%. If we do 6 months or 3 month here, so see P&L here. Yeah, waiting for that to just progress. But this month gonna be absolutely just dominating. Really, really ready to progress. And yeah, just being fully transparent with stats. We're starting this year strong. We're starting this year going forward. Okay. Anything that happened in the past months, past progression, options, been able to make some okay income across multiple different brokers, Robinhood, Webull, and TradeStation. But I think it's time for me to just lock in on shares, really find it in my bread and butter. And I just want to go ahead and teach you guys this as well too. Okay. Love you guys so much. Stay prayed up to God and head over to stackmode.net for all trading education. Let's do it. Don't ever give up. Keep grinding. And I'll catch you in the next one. Peace.
A CRM shouldn't weigh your budget down. It should lift your teams up. A CRM shouldn't hide fees. It should save you money. A CRM shouldn't slam you with add-ons. It should work with the tools you need. A CRM shouldn't leave you in the dark. It should deliver insights clear as day. Get started for free.
It's 2026. What's going on? We're back in the Stack Mode community, and first week, I just wanted to go ahead and recap and let you guys know what the business is. So we're up about 6% so far in the first week of 2026. I'm going to start doing a recap kind of once a month, just updating you guys on my P&L. Sometimes twice a month, showing you guys like the first week what my plan is, and then showing you guys like the end of the month result and showing you guys progression on how to start an account from nothing and grow it into something. So here, focusing a lot on AI stocks, tech stocks, and stocks that really have stuff to do with the future is really what I'm going to be going forward with this year. So a lot of people like to invest in stocks that have been around for decades and years and stuff like that. Me personally, I like to invest aggressively. This year, I'm going to be really focused on shares as well too, pretty heavily compared to options and futures like I have in the past. I'm really going to be just trying to go hard on shares this year, scouting out good companies, finding good buys, purchasing them, and just holding and sitting on my trades. That's noticing it's been working out for me really well. Been able to grow my account at a relatively fast pace. Been really happy with the profit. And one thing I really like about swing trading shares compared to options trading or futures trading is whenever you're swing trading shares, you can just sit back and chill on your trades. You don't have to worry about time, no expirations, no getting margin called. You could just buy your shares, sit and hold, and that's it. That's all you absolutely have to do. And taking your time on shares, trades, and scouting out the companies that are going to be making the most ample progression within our societies, getting rewarded for that, getting rewarded for your research, for your knowledge, for knowing to not buy at all-time highs and to buy at certain low areas. The reward that you get from shares compiled with the risk factor that's pretty much taken off, because say options, for example, I've changed my whole mental mindset. When it comes to options, people can pretty much sign a death contract. Your contract is pretty much locked in. It has to hit or it's going to miss. Okay, that's 100% just what it is with options. With shares, as soon as you buy, your money will fluctuate over time. But one thing about it is that you 100% do own. If your options is not going towards your directions, you're going to be losing. Okay, even with shares, if it's sideways or moving slowly towards your direction, you're still going to have all your capital. If you put down an options trade with not enough time and it's moving slowly towards your price direction, but it's still moving, okay, either A, your price is going to go negative on the contract due to theta and time decay, or your profit's going to be moving extremely slow and not how you want it. Also, another reason why I'm focusing on shares instead of options this year too is that at a certain point when you get too rich, you can buy all the options contracts for most stocks that you're looking at. Okay, so that's why billionaires have to play shares. So I'm trying to get to the financial point to where I'm one of the best traders. Okay, so personally this year I'm going to be focusing really, really heavily on shares. Got Bitcoin, of course, and in order to generate income, maybe later down the line towards this year, first couple months within the year, I look forward to playing some futures as well too. Okay, so I look forward to playing some futures within that. And I'm just going to be fully transparent with you guys at all times. I want to just show you guys stats, show you guys what I'm holding, and show you guys how I plan to continue to go forward. So let's go and let's jump into some performance, inshallah. So jumping into the stats here. So compiling an account, guys. Okay, I want to show you guys what it looks like starting an account from 0 to 4 to 5, 6, 7 figures. I want to just be fully transparent with you guys and show you guys how it's done. So starting here, you could see just have this account here, kind of restarted it in July 2025-ish. Okay, started growing it throughout this time, just reinvesting income from business, winning trades, adding over a single time. Okay, and as you can see, P&L is just heading in an upwards direction month after month after month after month. Okay, so your work income, your business income, or even your options and futures income should be funneled back into your account. Funnel it back into your account. Say your business, for example, if you're doing 5K a month in your business, okay, try and take 4K a month of that, okay, and invest it. Okay, you could put maybe 2K in the crypto, 2K in the stocks. Just try and break it down and invest what you're making. So your P&L is always going in an upwards curve. Okay, every time you guys get some money, try and invest. And then as you win trades, okay, there's going to be times where you may lose, okay, but then you're going to win more trades, get in different seasons, and continue to uptrend. Okay, if you feel like you have to invest every single time you get some money, then do that. Do that. Okay, I'm absolutely addicted to investing. I'm going to keep it 100%. Okay, shares is not something that I played past 2-3 years. Yeah, shares is not something that I've played or really looked at. It's really just been a lot of options in futures. I played options on Robinhood, TradeStation as well too. So I have some stats just spread across everywhere. But as far as Webull, I want to just use it for my shares portfolio. And I just want to be just fully transparent with my portfolio and how I plan to upscale it. Okay. So when you guys are growing your account, right, patience is going to be the number one thing. Okay. It's going to take time for you to know how to identify the setups you need to take. I recommend you guys go to Stackmode.net so you guys can get with my trading mentorship, so it doesn't have to take you a long time in order for you to understand what a decent setup looks like. But I went through a lot of unnecessary losses early on within my trading career due to the fact that I was just being uneducated and being impatient and being stubborn. Okay, so completely my fault while I was struggling in the beginning, but once I started getting my foot, I was able to go ahead and progressively increase my P&L year after year after year after year. Okay, so all your business income, all your work income, okay, after your bills are paid, of course, and make sure you guys are reinvesting the profits from the trades that you win. So your income vehicle generating skills are going to either be your options or your futures. Personally, I'm going to go with futures this year. I've played options for a few years and I like just the stability of futures and how you can just turn dirt into diamonds. Same thing on options too, but the time decay factor and stuff. But I don't know. I'll see even this year if I'll even touch futures or options at all, honestly. I might just stick 100% on shares, find little small caps, and just really try and turn up like that. And just continuously do my research on these stocks and these companies and try and catch some stuff at the lows. I'm really having fun doing that, finding the best companies and playing shares. Just really been having a blast. Options, it's really funky with options. Options has a lot of derivatives built into it. Price could be going in your direction and you could still be down due to multiple factors, due to like how much volume a contract has, etc. And all that stuff is just really ghetto, especially when So if you don't know, what controls the price of your rent, your groceries, the gas prices, as well as the crypto and stock market is going to be something called the Consumer Price Index, also known as the CPI. CPI is basically a giant shopping list that the government tracks every single month. They track food, housing, transportation, medical care, all the essentials. And when the total price of that basket goes up, inflation goes up. When it goes down, then inflation eases. And it sounds simple, but here's the catch. Even a small change can shift interest rates dramatically, which can impact your investments and even move the entire economy. Let's go on this jump into what CPI is and how we can understand what the report is. Inshallah. So let's understand the Consumer Price Index, also known as the CPI. It's going to be extremely simple, and I want to break it down. I want you guys to understand. Let's go. So what is the CPI in the first place? So the CPI, think of it as a basket of goods. So imagine a giant shopping cart that represents what the average American buys. This is going to go ahead and represent gas prices, groceries prices, food prices, the price of the current rent, housing, etc. Okay, all of this is going to be compiled into a big list, and the government tracks everything. And depending on how much this stuff costs, is going to give us a certain result based on the CPI report. So the Bureau of Labor Statistics, also known as the BLS, tracks the price of the specific basket every single month to measure inflation. Okay, so they measure housing, food and beverages, car prices, okay, and things related to cars as well too. Cars themselves, gas prices, and even ticket prices for planes and stuff, etc. Okay, and as well as the medical care prices, prices of certain pills, prices of certain procedures, etc. All of that gets tracked by the Bureau of Labor Statistics and gets put into a big report, and that lets us know how well the economy is doing. Okay, so let's continue on, and breaking it down and understanding this is really going to help us know, okay, is the market in a desperate period right now? Are people saving right now? Are people selling their houses right now? Okay, you really got to ask yourself a couple of questions and put things into perspective. Okay, so let's continue on and let's understand what the CPI is. So let's talk about measuring the inflation. Okay, measuring inflation. So the year-over-year review, YOY. Okay, when you hear inflation is 5%, it means that the basket of goods cost 5% more today than it did 12 months ago. So that means that the price of a hot dog, let's say in 2015, let's say the price of a hot dog was $2. If in 2025, the price of the hot dog is now $6, okay, inflation occurred. The price went up. The price of the hot dog got more expensive year after year after year. So within a 10-year span, hot dogs went from $2 to $6. So that means that it got $4 more expensive just because time occurred. So that's what inflation is, when stuff is getting more expensive over time. And the reason why that's occurring is because more dollars are getting printed. The more dollars that get printed, then the more prices have to equate for that. Prices are going to equate with how many dollars are available. If there's a lot more dollars getting printed year after year after year after year, then logically things have to result and coincide with that and get more expensive. So why investors even care in the first place? So if inflation is 5% and your portfolio grew 4%, then you actually lost purchasing power. And the core versus the headline. And so stripping the noise. So there's going to be two main types of CPI numbers that are going to go ahead and be released. So there's going to be the headline CPI. The headline CPI is everything in the basket. So once again, we're calculating the food, rent, gas prices, okay, price of certain waters, whether that be for water in our houses, for shower, toilets, etc., or the price of bottled water, okay, price of ice cream. All of that is going to be calculated inside of the basket, and the actual raw number is going to let us know how much Americans are spending on consumerism. That's why it's called the CPI. consumer price index, letting us know how much the economy has consumed. And the core CPI, okay, it removes the food and energy prices from the equation. So the core CPI removes food and energy prices because food and gas prices are going to be volatile. They change every single week, okay? And they change a lot quicker than other things as well too. Okay? Food can be thrown on sale one day. A box of macaroni could be $5. Okay, you come back to the store next week, and it's back again at $15. Same thing with gas. You could go to one gas station, they might be charging you $3 a gallon for some 87, and then another gas station for some 87, it might cost you $2.79. Okay, so it's really going to go ahead and differentiate, and food and energy are going to be a lot more volatile than other things related into the basket. So the Fed prefers there's just the core CPI, and the core CPI is the number calculated in the basket of the stuff that Americans are consuming, okay? And other countries have CPI too, but in this case, let's talk about US, but it takes the amount of resources that a country is consuming, and the core CPI report is just going to go ahead and remove food and gas prices since they're volatile and could hedge the numbers and make them spike up higher than they maybe should be. So the federal connection. So we'll talk about the policy tool. The Federal Reserve has a mandate to keep inflation at around 2%. 2% is going to be a pretty stable rate, and that's letting us know if the economy is not going in haywire. So a high CPI, the Fed will raise interest rates to cool the economy down, which is going to be really bad for stocks and bonds. If people are paying more money in percentage yields on interest, then that's going to go ahead and leave them less money to invest. Or what people would go ahead and do is take out their investments in order to make up for certain interest rates getting more expensive, etc. And we'll talk about a low CPI rate. So when the economy is in a good position, it's very stable, and it's in a cool position, the Fed may lower the interest rates to stimulate the growth because people are going to be paying back less in loans, paying back less in debt, etc., leaving a lot more supplemental income to invest into stocks. So when the CPI report is low, a lot of the times you start seeing market burst up in an upwards direction because it's letting us know that everyone else has money, and the stock market and crypto market, we move as whales and sheeps. Everyone has to be doing the same thing in order for the market to move. Everyone has to be buying at once in order for it to go up, and everyone has to be selling in order for it to go down. So that's why it's really imperative to make sure you're trading with the trend. If you're not trading with the trend, you're just going to be losing money for no reason. And that's why Wall Street really holds its breath on CPI release date. It's really a big report that predicts what the Fed will do next, and a big predictor on how the market will move. A lot of times right after the CPI report drops, especially if you're a futures or forex trader, you can get on your 1 minute and you can see the actual candle of CPI. So seeing that and watching those month after month after month of CPIs really taught me and let me know how the market decides the trend after CPI report hits the market. And market volatility, so the tantrum that it throws. So algorithms read the CPI report in milliseconds, and the market reaction can be extremely violent. In a second, CPI could make the market zip down, or higher. So interest is going to be bad. There's a reason why God talks about it in a negative manner. Interest does not benefit anything. Interest only hurts. It hurts the people, hurts the stock market, and it just leaves us less money in order for actually building our actual assets, whether it be it for real estate, building your stock portfolio, etc. And if the CPI report comes in cool and lower, a lot of the time stock has a good chance to rally in an upwards direction. Same thing with the indexes, known as the NQ, which is going to represent for the NASDAQ 100. You're going to have the ES, which is going to represent the S&P 500. You're going to have the Dow Jones, which is going to represent the YM, also known as US 30. Okay, so each one of these things are going to be affected by the CPI. So CPI is an extremely be doing. And then boom, they're going to go ahead and put that money down. So watch the trend. One bad month is not a crisis, but a trend is. Watch how the trend shifts after CPI. Does market want to head in an upwards direction? Does market want to go in a negative direction? Okay, and for how long? Make sure you're trading with the trend. Trading with the trend is going to be the separation tool between being profitable and unprofitable. Okay, you have to make the decision that the market is making. Otherwise, you will lose money. If market's going in an upwards direction, that is the direction that you should be playing in. And it's not at all-time highs, then that's how you should be playing. Okay. If you're on a Forex trade for something like that, for example, and the CPI report comes out and a currency pair starts going downwards, okay, then that's going to go ahead and let you know the trend. I don't care if you're on stocks, Forex, futures, wherever. Be wary of the CPI report, especially before you put in the trade. Okay, keeping an eye on news, and a lot of the times you'll notice too, news is going to be baked into the price action too. So try not to fight the Fed. If CPI is high and rates stay high, try to adjust your portfolio. Okay. Stay prayed up to God. Keep grinding. If you want to learn more about investing, head over to Stackmode.net. I'm here for you guys for any type of situation, whether you guys are struggling with unprofitability, whether you're profitable right now, but you just want to be a little more consistent. You want to see how you can funnel more of your income. Just come book a free call. I'm here for you guys. I'm going to catch you guys in the next one. Peace. When a company drops its earnings reports, it's like opening the result envelope on award night. Traders, investors, hedge funds, everyone is waiting to see if the company beats expectations, meet them, or completely miss the mark. And depending on that reveal, price action can turn into a calm wave or a full-blown tidal surge. During earnings, companies reveal how much money they made, how much they spent, and what they expect for the future. And here's the twist. Sometimes a company posts great numbers, but the stock still tanks. And here's why. Because Wall Street wasn't impressed, or the expectations could have been higher than reality. And other times the results are just okay, but the stock still shoots up because traders were expecting something a lot worse. In just a few minutes, spreads widen, volume spikes, and algorithms fire off like fireworks. And this is why many traders either love earnings season or avoid it like a thunderstorm. A lot of the times though, in order to avoid gambling, it is better to place your trades after the earnings report has released. So let's go and jump into what earnings is and how it affects the market. Inshallah, God wills. So we're going to go ahead and cover earnings. So what happens when financial earnings release? Okay, so every quarter, okay, every couple of months, financial earnings are going to be a report that determines the amount of money that a company made, okay, and the amount of expectations that they were trying to arise to. So if a company was projected to make $500 million, but they only made $300 million, then in that case, they would go ahead and lose earnings, okay? But if a company was projected to make $500 million and they made $800 million, then that would go ahead and be a positive earnings beat, okay? So earnings are going to go ahead and determine the price action too. Now, just because earnings gets beat or earnings loses doesn't mean that a stock will head up or down, okay? Stocks will do whatever it wants. Do not try and use the earnings releases to try and gamble and make trades, okay? Try and trade after earnings releases if you're going to put down a brand new position, okay? Wait for the price action to kick in, and then after the earnings release comes, then feel comfortable to make your trade. But never trade like a day or a couple of days before earnings. Wait for earnings if you're a couple of days before earnings, okay? Wait for earnings to come out and then take your setup, okay? Because otherwise it could be gambling. Earnings causes stocks to make giant moves quickly, okay? So the moves that happen during earnings are going to be extremely instant, and it's going to be like a flash move based on the report. So let's jump into it. So the quarterly report, right? 10Q. Okay, every 3 months, public companies are required by law to reveal their financial health to the public to let them know how they're doing. Okay, it's going to go ahead and let investors know if they want to keep throwing money into the company or not. If a company is not beating earnings, then that means that they're not making any type of income. Okay, and a lot of the times we don't want to be invested into something that's not even making income in the first place. So every 3 months, public companies are required by law to reveal their financial health to the public. Okay, and let's talk about the revenue. So revenue is going to be how much money came into the door, okay, how much money did that company make during that quarter? And the net income is going to be the bottom line. It's how much profit is left after expenses. So certain companies might have to pay for building power, warehouse cost, employees cost, etc. And the EPS, it's going to stand for earnings per share. And it's the profit divided by the number of shares that are going to go ahead and be available. Okay. So EPS, net income, and revenue. Those are going to be the three factors and the three things that are shown on the quarterly reports. Okay, so let's keep jumping into it. So the expectations game, right? The actual numbers don't matter as much as the expectations. Okay, so once again, let's say a company was projected to make 100 million, right? Expected, but then they actually made 170 million. Okay, that would go ahead and give them a beat result. Okay, so whenever you hear the words beat, that means that the results that actually came out were going to be better than what was projected or speculated in the first place. Okay, so priced in. If everyone expects Apple to make $1 billion and then make $1 billion, the stock might drop. Okay, why? Because the good news was already bought weeks ago. Okay, so to see a stock pop, a company usually needs to beat company earnings, okay, and beat the analyst consensus estimates based on the company's averages is how the estimates come out too. So it's not just going to come out with random numbers. If a company is making around like $50 million a year, okay, the earnings might be around like $60 or $40 million expectations. Okay, it'll be around where the company is performing as of recent years. Okay, so don't just expect the numbers to just be some random inflated numbers. These are all numbers that are going to be based in and baked into averages for a reason. Okay, earnings come into play. But once again, don't try and just hop in a contract the day before earnings trying to trade like that. Please don't do that. Okay, please don't do that. Now, sometimes there's going to be little rumors as well too. You'll see like, oh, this company is going to be earnings. Nobody knows what's going to happen until the earnings report actually comes out. So please do not lose money gambling for no reason. Okay, wait for the earnings report to come out. Unless you're in a hefty swing already, please wait for the earnings report to come out. Okay, let's keep going into it. And understand that guidance is going to be king. So stocks trade on the future, not the past. Okay, so guidance. Guidance is going to be the company's prediction for the next quarter, how much money they're going to be making. Okay, it's pretty much going to be giving the company a trail and letting them know how they should be performing in order to get to the next level. So in any scenario, company reported record profits. Okay, but let's say next quarter looks slow. Okay, then that'll be the future. And results, okay, the stock would go ahead and crash if that's the case. So we're lowering our outlook due to supply chain issues would equal an instant sell-off, since that means they're pretty much letting us know, hey guys, the company can't expand right now because of financial issues. Okay, so guidance in the future of the company is also going to be really, really important too. There might be times where a company might lose or not beat their financial earnings, but then end up making a pretty profitable couple of next quarters. Okay, so one quarter is not going to go ahead and determine a company's entire worth. It's the consistent stream of quarters and reports year after year after year after year. If a company is consistently losing earnings, then that tells you about the company. Okay, so we'll talk about the implied volatility crush. So IV is going to stand for implied volatility. So before earnings, options prices can get very expensive. This is called high implied volatility. So it's like buying insurance right before a hurricane, okay? Or driving your car and then you just put insurance on it, you know? So before the release. So uncertainty is high, so options get more expensive in this case, okay? So if you are going to buy a contract before earnings come out, okay, make sure you sell it before earnings come out too. Don't gamble and sell your contract after earnings comes out, because then the uncertainty would go ahead and vanish. Okay, unless you're playing for a way bigger take profit that's going to be way further out than you think. Okay, then try and sell your contract before the earnings comes out, because it's going to be worth the most expensive then. Okay, so buying options right before earnings often loses money, even if you guess the direction right. So if you buy a calls contract and the company beats earnings, and even if price goes in an upwards direction, okay, you might notice that your contract didn't even make you that much money. Okay, that's because price has to get rebaked into what it actually is supposed to be. So do not buy earnings before expecting you to catch the right direction. Okay, because even if you do catch the right direction, you're probably not going to make as much money as you would think. Okay, especially depending on the contract that you buy. Okay, the reasons why contracts get expensive like that before earnings is because they don't know what the number is going to go to. Okay, that's why. So implied volatility makes things more expensive. So understanding this really helps us. Let's head over to the next slide. And let's go ahead and let's talk about the gap. So earnings are usually released after the market closes. So it's usually after 4 p.m. Eastern Standard Time. Okay, or it's going to be before market opens. So it's going to be before 9:30 a.m. Eastern Time. So you cannot trade standard stocks during the release unless you have extended hours access. So a lot of the times, once again, just like I talked about earlier, you're going to see that instantaneous price action. So the stock price will teleport, so it instantly gap up or down. Okay, and stop losses do not work against gaps. If you hold overnight, then you're going to be taking the full risk. So just know that even if you have a stop loss placed during the day, if price decides to run through wherever your stop loss is, then what it's going to go ahead and do is decide to not validate and just ignore all of those orders due to the fact that the price action is happening pre-market and after market. Okay, and you can only maneuver your options contracts. If you have shares, you can close a little before or after. Okay, but if you're on options, you've got to only get what you get when you wake up to the contracts. Okay, so even if you see price going in an upwards direction and you had some calls, don't expect money all the time. It really depends on a lot of things such as implied volatility, etc. Okay, so expectations matter. Okay, so beating estimates are required a lot of the time for a stock to go in an upwards direction. Okay, in order to start seeing a rally, and guidance is going to be critical. So the future outlook is a lot of times going to go ahead and overshadow the past results. And volatility crush. Options lose value instantly after the news. Okay, so you might notice a contract might be $500 before the news. Okay, and then after the news, it might go down to $200, even if the number were to go ahead and hit. Okay, so options lose value instantly after the news, and the gamble between everything. So holding through earnings has a high risk. Okay, just a high risk factor. I'm not even going to say high reward. Okay, because the reward that you were to get is not even worth it, and you wouldn't even get it as properly as you would. Now, if you're holding a super swing, okay, you're trying to hold a trade for months, weeks, some years, etc. Okay, then I do understand. Okay, do your thing and hold your trade as you need. But a lot of the times, make sure you're closing your trades before earnings come out. Okay, unless you know exactly what type of swing that you're holding. Okay, head over to Stackmode.net to learn more about anything stock related, investing related, or trading related. I'll catch you guys in the next one. Peace.
Class, let's go and let's jump straight into it. Today we're going to be talking about mastering financial analysis, and this is going to be the beginner's guide. So what is a financial statement analysis? Financial statement analysis is going to be the process of reviewing and evaluating a company's past and present financial reports, the three statements, to make better economic decisions. And then it involves calculating key ratios and comparing data over time against competitors. So we want to be making sure we know how to read how much is a company making. Does it have a lot of debt? And are we going to be able to profit off the company due to the fact that A, they're putting a smile on people's faces and it's a profitable company, which is going to affect the future? And is it a company that's hiring people and nonstop making profit? Okay, because that's going to let us know that the share price has an incentive to increase. So it's going to be a comprehensive course on analyzing a company's financial health. Let's understand that the financial statements are going to be the bedrock of intelligent investing, effective management, and sound business decisions. Whether you're an aspiring investor, a business student, or a founder, these skills are going to be fundamental and imperative. So let's take a look at past performance. So you got to look at past performance to identify trends, growth rates, and recurring issues with the company. And comparative analysis, benchmarking the company against its closest competitors, peer group, or industry averages. Okay, see how it's faring up. If it's a tech company, see how it's faring up against other tech companies. If it's a healthcare company, see how it's doing against other healthcare companies. Okay, and do it like that. and forecasting, using historical data and current trends to project future financial performance. So it allows us to answer certain critical questions about a business. Once again, how much money are they making and are they in debt? It's pretty much going to be the two main questions that's going to let us know if something's going to be a good investment or not. So the income statement, profit and loss, and measuring performance. So the income statement is also known as the profit and loss statement, and it measures a company's financial performance over a specific period of time, for example, quarter or a year, and it shows how revenue is transformed into net income. And the core structure, a journey to profit. The statement is constructed like a ladder, and subsequently deducting expenses from revenue to arrive at different levels of profitability. And the revenue sales. Revenue is going to be the total amount of money that's generated from the sale of goods or services. And this is going to be the starting point. And the first thing we want to look at is the company making money in the first place. Let's check the cost of goods, COGS, the direct cost attributable to the production of goods or services sold. And this includes raw materials and direct labor. And gross profit. Gross profit is the revenue minus the cost of goods sold. And this metric shows a company's ability to manage its production cost. And operating expense, OPEX, the costs not directly tied to the production, and primarily selling, general, and administrative, SG&A, and research development. And operating income, this is earnings before interest and tax, and this represents the profit generated from the core business operations. And let's talk about net income. Net income is going to be the bottom line, and net income is going to be the operating income minus interest expense and taxes. And this is the profit available to shareholders. So the key income statements, ratios. How to analyze the P&L effectively, you got to use margins to see what percentage of the revenue remains at certain profit levels. And gross profit margin is calculated by dividing the gross profit by revenue. And a higher gross profit margin indicates better efficiency in production, which means they can go ahead and scale the business up while still bringing in profit. Okay. So the balance sheet, the accounting equation. So the balance sheet provides a snapshot of a company's assets, liabilities, and the owner's equity at a specific point in time. And it's based on the fundamental accounting equation, which must always hold true. So the foundation assets, okay? Assets equals liabilities plus equity, okay? So this equation dictates that everything a company owns, its assets, must have been financed either by debt or by owner's contributions, which is going to be the equity. So assets, they're going to be whatever the company owns. Assets are anything of economic value that can be used to produce goods or services. And current assets, they're expected to be converted to cash within 1 year. For example, cash, accounts receivable, and inventory. And non-current assets. Long-term items are not easily converted to cash. Okay? Property, plant, equipment, and intangible assets. And liabilities, they're going to be what the company owes. Liabilities represent the company's obligation to external parties. So current liabilities, obligations due within 1 year, for example, accounts payable and short-term debt. And non-current liabilities, obligations due beyond 1 year, for example, long-term bonds and deferred tax liabilities. And section 3, the shareholder's equity, okay, and that's the owner's claim. And equity is the residual claim on the assets after all liabilities have been paid off. And it includes common stock and retained earnings, which is cumulative net income minus the dividends paid. So that's how you get that equation too. And so let's talk about tracking real cash. The cash flow statement is often considered the most reliable statement because it bypasses non-cash entries like depreciation and crucials found in the P&L and balance sheet, and it shows the net change in a company's cash balance over a certain period of time. So the 3 core activities, OIF, the CFS is divided into 3 sections that explain where cash was generated or spent. So 1, the cash flow from operations, CFO. This section starts with net income from the P&L and adjusted for non-cash expenses and changes in working capital accounts. This tells you the actual cash generated by the company's normal business activities. So the key adjustment, adding back depreciation and amortization, which is pretty much going to break down expenses on the P&L, but do not involve an actual cash outflow. And working capital changes. Changes in accounts like inventory, accounts payable, and accounts receivable are adjusted here to reflect real cash movements. And cash flow from investing, CFI. This tracks cash used for investments in long-term assets or revenues from selling them. And the largest item here is usually capital expenditures, CapEx, which is the cash spent on maintaining or expanding PP&E. Okay, so interpreting CFI. So a negative CFI, right, which is going to be the cash outflow, is often a sign of a growing, healthy company that's investing heavily in its future by purchasing equipment or new facilities, looking to scale its business outcome and business income by putting all the profit back into the business pretty much. And a large positive CFI may indicate a company is selling off core assets, which can definitely be a red flag, okay? Which means they're going broke. So if a company's going broke, that's not a good sign. And it's a good sign that the stock might actually crash within a negative direction. So check a look for that. So turning data into insights. Ratios allow us to standardize financial data across companies of different sizes and assess specific aspects of their health. Most notably liquidity, which is the short term, and solvency, which is the long term. And liquidity ratios, can we pay the bills? These ratios measure a company's ability to cover its short-term obligation using its short-term assets. Generally, a higher ratio is better, but industry context is crucial. So it's current ratio. The most common liquidity metric is it compares a company's total current assets, which is its cash, receivables, and inventory, against its current liabilities, which is its payables, short-term debt, etc. And the ratio below, let's say $1, is usually a 1 sign. And the current ratio is calculated by dividing current assets by current liabilities. So, quick ratio, the asset test ratio. A stricter test of liquidity, excluding inventory from current assets, as inventory can be slow to convert to cash. And this ratio focuses only on the most liquid assets. And the quick ratio is calculated by subtracting inventory from current assets, then dividing the result by current liabilities. So, solvency ratios, long-term survival. Solvency ratios gauge a company's ability to meet its long-term debt obligations, and whether it is financially sustainable. Excessive debt can cripple a business during economic downturns. So debt to equity ratios, DE. It compares the amount of debt financing to the amount of owner investing financing, and a high ratio indicates a company is highly leveraged. And the debt to equity ratio is going to be calculated by dividing total liabilities by the total shareholder equity. And let's talk about the interest cover ratio. It measures the company's ability to cover its interest payments using its operated earnings, the EBIT, and the interest coverage is calculated by dividing EBIT by interest expense. And a ratio of $1.5, for example, or higher is generally considered safe, but the higher is going to be better. So putting it all together, let's talk beyond the numbers. While the financial statements provide the objective data, a world-class analyst always incorporates qualitative analysis to provide context and foresight. And let's talk about the qualitative factors, the moat. These are non-numerical factors that determine the longevity and strength of a company's competitive advantage, its economic moat, and management quality. It assesses the track record and reputation of the executive team and asks, do they make rational capital allocation decisions? Are they investing their profit properly? Okay, and asking those questions is going to be a good thing to know before we just put money into an investment. And do an industry analysis. Is the industry growing or is it shrinking? Okay, tech industry as of currently in the 20th century has just been booming, for example. And what are the key competitive dynamics? Okay, is there any threat of new entrants? And what's the pricing power of it? Okay, and competitive position. Does the company have a sustainable edge? Okay, patents, brand recognition, low cost reduction, and how many smiles does it put on people's faces? And the small summary of the three statements. Okay, the three financial statements. Okay, one, your income statements. That's going to be the performance over a period, and it focuses on the profitability. Okay, for example, margins, how much money a company's making. And the balance sheet, it's going to focus on its assets, liabilities, and equity at a point in time, and it focuses on resources. And then we have the cash flow statement. It tracks cash movements over a certain period, and it focuses on liquidity and funding activities. Okay, so look at all of them. Okay. So your goal is to cross-reference the three statements. For example, if the net income, okay, is high, but the cash flow from operations is low, it suggests that the company is booking sales, but not collecting cash. That's a critical finding, okay, meaning that it's sinking, okay? So figure out what you guys want to invest in, okay? Stay prayed to God, keep grinding, and head over to Stackmode.net to learn how to trade and invest. Peace.
We have got to the point where literally anybody can build a fully working app without knowing how to code. This is Base 44. This is a first look at the current industry-leading AI app builder, and you wouldn't believe the kind of apps that people are creating. Smart nutrition apps, inventory trackers, onboarding tools, you name it. And if the only thing stopping me from making the app is the idea, then why not build an app that gives me endless app ideas? So let's make it. Pro tip, I draft the full app spec in ChatGPT, and then I drop the prompt directly into Base 44. It gives me super detailed structure. And here it is. Everything I laid out in detail as it goes. This is pretty awesome, but I want to make it playful. So I'm going to add a swipe left and swipe right interface. The same usability we all know. Now I'm going to add one more feature. So every idea that I favorite will turn into a kickoff prompt to start building the app itself. And that's it. Just come up with your idea, any idea, and Base 44 will do the rest. So go to Base 44 and create apps with your name on it.
Your father knows about saving money. Everything I'm wearing, I've had since boot camp.
And I just saved on my car insurance for driving safe with USAA.
Auto insurance that flexes with you.
Fit to fit.
That's what we're made for.
Stackmode. Good morning. What's going on, guys? So, I'm going to be telling you guys about some crazy sauce today. If you didn't know, there's a law called the short sale restriction. It literally prevents stocks from flash crashing to zero. I was having an argument with my mom the other week, and growing up, she definitely put me in place to get a good job. When I first came up, I worked IT. I've only ever worked from home, doing work from home positions. Thank God, all credit due to Allah. But I was only able to work for so long without starting a business, though. Once I started realizing that you're at the mercy of a company, and even seeing team members just get fired instantly, dropped randomly, made me think, okay, they have bills too. They have stuff to pay for too. I don't want my family in that predicament. So let me hustle harder. Let me make sure my money's always moving, and let me make sure I can get monetized on YouTube, etc. Thank God. So I can always be making some income in case the job decides to fire me. Okay, which definitely does happen to a lot of people. So stocks are extremely consistent. These companies go up year after year after year after year. And the reason why these companies fire people in the first place is because they're doing what's best for the company. The company, a lot of the times, will always do what's best for the company. That reason alone, too, is also one of the big reasons why stocks will continue to go up. So let's jump into this presentation. I want to break down what the short sale restriction is and what prevents stocks from crashing to zero. This is why the stock market is consistent. Let's do it. So whenever bad news hits, panic selling starts, and it happens rapidly most of the time. Short sellers pile on, aggressively selling to drive the price in a lower direction. And it feels like there's no bottom. Sometimes you might just see falling happening for days, especially on some certain stocks. And panic selling plus shorting equals the term crash. So if you've ever heard a term of the stock market crash, it's referring to a bunch of selling happening. Okay, so whenever you see a bunch of selling happening, that's going to go ahead and refer to the terminology crash, shorting, selling, etc. So the law, the SEC rule 201, so the short sale restrictions, it's a safety mechanism designed to stop artificial market manipulation. And the trigger, so if a stock drops 10% in one day, then it's going to go ahead and trigger. And the circuit breaker activates instantly. And it lasts for the rest of the day, plus all of tomorrow. Have you guys ever seen something called a halt? Okay, so if you ever seen something called a halt, it's when the stock is paused from all buying or selling, and the back end system has to go ahead and catch up on pretty much all the price action that was happening within that period of time. So sometimes you might see stocks get halted, especially small caps or penny stocks. When they start rising or a lot of price action starts being influxed into it, whether it be buying or selling, a halt can come into place in order to pause the price action, let the stock catch a rebalance, and then it'll be listed again for people to purchase. And how it stops the crash. So no more hitting the bid. Normally bears can force the price down by selling at market price. And under SSR, short sellers are banned from selling at the bid, and they must place orders above the current price. And they can't push, they must wait. And this slows momentum and allows buyers to step in. So think about that within logical sense. So it stops the crash, okay, and it forces price down, okay. So price can sometimes be forced down by massive selling or people just releasing orders that have been stocking up a majority of it. Let's say in the crypto sense, if someone has a majority of the liquidation or majority of the liquidity, then they're going to be able to go ahead and sell off a majority of their stock or shares, let's say even a penny stock. Whoever has a large majority of it, if they sell off, market will dump. And you'll see that, especially even at the middle of the night trading certain sessions. Let's say you're trading something that's based around New York session between the 9:30 a.m. and the 6:30 p.m. or 4:30 p.m. session, let's say for just options. Okay, no extended hours, let's say just actual trading hours. So 9:30 a.m. to 4 p.m. Then you're going to be able to go ahead and place your orders between then. But afterwards, only aftermarket traders can trade if it's not futures. And a lot of the times, that's when a lot of price action comes into play. So since a lot of the open orders are going to go ahead and be closed out, only people who have the control aftermarkets are really going to be in a large majority of control within the price action. So a lot of the buyers and sellers, after the open market orders are done, are going to go ahead and fluctuate the price action. Let's say if you're playing futures, CL, okay, let's say you're trading oil. If you're trading oil, then try to get on oil in the middle of the night. If you see someone place a bunch of contracts and you're on the smaller time frames or even like the daily or 4 hour, you'll see price action rapidly move if you have a tape. And tape is going to be a tool to where you can go ahead and see all of the orders. So look at market during times when a lot of the open orders aren't active, whether it be Forex futures, depending on the time zone is going to be depending on what you're looking at. But whenever most open orders aren't active, try and look whenever market is after hours, and then try and look at what's called the tape. It's going to show you a majority of the orders which are coming in. And if you see a order get placed in, let's say for 100 contracts, okay, of oil at the middle of the night, you'll definitely see price burst in the upwards direction a bit, okay, reflective to the orders that just got placed in. Same thing if someone sold, you would definitely see price head in a downwards direction right afterwards too. So you guys can use the tape indicator or the order flow, and you're going to go ahead and be able to see the orders that are coming in. So let's talk about inflation in depth here. So this is the money printer. So central banks target 2% inflation, and they constantly add money to the system. And if there's more money chasing the same amount of stocks, the stock prices must rise in nominal terms. And stocks are going to be a hedge against cash devaluation due to the fact that these companies still have to survive. So the more that these companies thrive, then the more that the stock price is going to go ahead and increase. Thus meaning that your cash is going to be the safest within the stock market majority of the time, since it's going to be inflation proof. You keep your cash, once again, in a bank account that just sits there, your dollar only goes down. It's illogical. Don't do it. It doesn't make sense. Okay. If you're trying to win, if you're trying to be profitable, you have to change your whole mindset. Your mindset and changing the way you think is really where it starts. I don't want you guys to be in the same loop. I don't want you guys to be doing the same things. And understand that when it comes to the stock market as well too, investing, I don't care if it's crypto even, you get paid based off of how disciplined you are. Okay. It's a test of who can put away the most money, who can be in stack mode. Okay. Once again, stack mode is about being a God-fearing, righteous individual. If you can put your money away, put your desires to the side, put your flesh to the side, you'll win. Wake up, pray to God, put your desires to the side, put your flesh to the side, and you'll win. Stay focused, stay consistent, work, invest, work, invest. Just work, invest. Okay. Wake up, pray, work out, take care of your health. Okay. Water, fruits, etc., vegetables. Then work, invest, give it time, get in stack mode, and you'll win. Okay. It's going to be a multiplicative journey. The more that you invest, the more focused that you are, the more disciplined that you are, the faster that your income is going to be succeeding to the numbers that you want to see. If you want to start making 4 figures, 5 figures extra a month, then it's time to start putting away 80% of your income. Make sure all of your bills are paid. After bills, go ahead and invest, 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 invest. Try and work every single day. Try and increase your income every single day so that you have more money to invest and put yourself in the asset river. Okay. The asset river is extremely, extremely important. I just want you guys to be stacking cash, stacking assets. I just want you guys to be successful. So let's keep going. Let's head over to the next slide. So survivorship, right? The index cleans itself. The S&P 500 is a survival of the fittest competition. So losers, they bankrupt companies and they're deleted from the index pretty much. So bankrupt companies are deleted from the index. So we do not want to invest in bankrupt companies, obviously. Try and invest in companies that have positive revenue projections, even if they're not making revenue right now. If they have plans to make revenue, whether through deals, bills through the US government, etc., such as like Intel, for example. I just gave out a good trade in the group, already up around 30% on this. Intel signed a deal with the US government for like AI chips, if I'm not mistaken. So try and look for companies that are making deals or have any future projections to increase their revenue, or try and look for companies that are increasing their revenue currently every single quarter. So every couple months, reports are going to come out, and it's going to be called earnings reports. And these earnings reports, you're going to be able to track the amount of money that the stock is actually making. So I'm going to drop tons of videos, tons of content for you guys. I'm also going to drop a full course, the in-depth research course. And winners, so successful companies like Tesla and Nvidia are going to go ahead and be added as well too, due to the fact that they didn't go bankrupt. They survived, they innovated year after year, and most importantly, they increased their revenue. So any company that can increase their revenue year over year over year over year over year is what we want to be investing in. Or any company that has any projection to have good deals or bills to be signed or good collaborations, then bet on the winners, invest on the winners, and that's where you're going to get to where you want to be, inshallah. Let's head over to the next slide. So engine number 3, so innovation, so human productivity. So humans naturally solve problems. We invent technology over time. So if we're hot, you know what I'm saying, we invented the AC, the air conditioning. If we had no house, so we were outside, we invented, you know what I'm saying, the house. We started innovating with bricks, drywall, clay, wood, etc. Okay, instead of just laying down some twigs and leaves, we started innovating and making structure. Okay, so humans will always innovate. If we had no shoes, what do? We made some shoes. Got us good. Okay, so we turn our brain on. Thank God we have that ability, and we decide that we don't want to go through pain anymore. So we decide to solve problems. So we invent technology now, going forward into this generation, and we have AI. AI stands for artificial intelligence. It's pretty much just softwares that do things for you, make things faster and more efficient. You have AI stocks for sound, for music. You're gonna have AI stocks for grammar, whether if you're writing a book and you need the AI to correct your whole book and fix any grammar issues. You're gonna have AI for art, AI for number generations, AI just to ask questions as well too. Okay, just a multitude of questions and problems that AI can go ahead and tackle, and that's what these companies are going to be innovated based off of. So look at all these factors I just listed here. You got art companies, grammar companies, sound companies, all these different type of companies here, power companies. Okay, all these different type of companies are going to have a multitude of stocks that you could go ahead and invest in that all have future projections and value in them. Okay, try not to buy stocks at the tippity top at all-time highs. Of course, we want to buy low, sell high. It's very simple. I know it sounds simple, but some people still struggle with these things. So I just try and recap and make sure that it's broken down. So you want to buy low, sell high, and productivity equals profitability. And as companies become more efficient year after year, earnings rise and stock prices follow earnings over the long term. So try and invest into stocks that have a good future projection, so you're not just wasting your money and your time. And historical proof. So every crash has been bought. So the 2008 crisis. Okay. The market dropped 50% and recovered to new highs by 2013 and 2020 COVID. So the market dropped 34% and recovered to new highs in 5 months. 5 months. And betting on the end of the world only pays off once. Stop shorting the stock market. The stock market is literally created to go in an upwards direction. If you're going to short it for like 2 seconds. But trying to bet on a stock's whole downfall and downturn, most of the time you're going to lose. It's literally created to go in an upwards direction. These companies are the backbone of the entire United States infrastructure. And you have to think like that. You have to think smarter. You have to think wiser. And you got to shake out of that. You got to shake out of any mental breaks that you've been in, any mental loops that you've been in. And you got to just go harder. You can't let things stop you. You can't let things break you down. Okay. And even if a stock is crashing, you need to see that as an opportunity. You need to see that low as a sale. Whenever market's going down, you need to see market is on sale right now. It's on discount. Just like you like to go to the thrift store so you can get clothes for cheaper. Or you like to go ahead and order DoorDash with this discount code to get it some % off. Okay. Whatever you're doing, you're trying to get it on sale. So treat your portfolio the same way. Treat stocks the same way. Don't buy when the stocks are at the tippity top. Wait till they go down. Wait till it's at a low. Wait till it's on sale. And after buyers have stepped in, which you can head over to Stackmode.net, book a free call, get my course, book whatever, and I show you guys how to identify lows. But after you identify the low, go ahead and make your decision. Wait till buyers step in. If buyers have stepped in after sellers have done selling, go ahead and buy. Catch your sweep up and catch your V setup. Okay. The V guide. Okay. The V guide. It's really, really easy. It's strong to catch the trend. Whenever you see market come up, okay, wait for it to come down, then you buy. Take it back up, wait for it to go down, buy, then you take it back up. You do that over and over and over again until you perish into the grave. Inshallah, if God wills. Let's go to the next slide. So short term. So the SEC Rule 201, which is the short sale restriction, prevents panic from destroying value artificially. And long term, economic engines ensure that the broad market trend is always up and to the right. Okay. Find stocks that have good future value. Find stocks that are helping people. Find stocks that are profitable. And find stocks that are involved with other already profitable stocks that are new and up and coming, since the world is changing every single day. Technology is changing every single day. Innovations are being created every single day. I don't know if you guys have seen, I've seen something recently me and my wife have been looking at. It's called the boneless couch. Okay, you can just literally inflate the couch. You don't need to move it in and twist it to the side and hold the arms. You don't gotta do nothing at all like that. You could just get the couch out the box and it'll inflate itself. So as humans, we're innovating literally every single day. So many new companies are hitting the stock market. You don't only have to just think about the S&P 500. And I want to show you guys that you can consistently outperform the S&P 500 year after year after year. Check out my last video that I just dropped showing you guys raw performance. S&P 500 is only up 1.5%. I'm already up 8% almost this year. Okay. Go hard. Outdo the statistics and don't listen to the programming. Okay. Go hard. They tell you to invest in S&P 500 for 1% or something a year. Go harder and outdo that. Show them you could do 100% gains every single year and outdo the competition. Outdo anything that you've been told and do you. Okay. Stay focused on God. Keep grinding. We'll catch you on the next one. Head over to Stackmode.net for all trading education. Peace.
When the dollar starts becoming worth less, people start running to assets such as real estate, gold, and silver. Today, we're going to talk about how to invest into gold and silver, why you should invest in the gold and silver, and what inflation is, and why people run to asset classes in the first place because the dollar starts failing. Let's jump into it, inshallah. So gold and silver are going to be hard assets that are going to be pretty safe to invest in, especially in an inflationary world where things just get more expensive over time due to the fact that more currency just gets generated over time. So the currency devaluation. So purchasing power is melting over time. So inflation isn't just about prices going up over time. It's about the value of the currency going down. So prices go up to correlate with that.
So governments print money to service debt, which dilutes your savings over time. This is why I tell you guys all the time about the asset river. Okay. You want to always try and have your assets and your money flowing in your river. If things logically get more expensive year after year after year after year, then you have to have your assets flowing in a way that your money is always making you more money. Okay. So once again, I'm going to repeat, your money should always be making you more money. Okay. Don't get outplayed by the certain calculations that just debase in the world normally. If things get more expensive over time, then logically, in order to counteract that, in order to feed yourself and your family, your money should always be making you more money. So we'll talk about the 1971 shift. So that's when Nixon ended the gold standard. And since then, the US dollar has lost over 85% of its purchasing power. And the hidden tax, inflation helps debtors, which is pretty much just the governments, but it hurts savers, anybody just stacking up cash in your bank account. If you have just a whole bunch of cash stacked up in your bank account, it's actually doing nothing but hurting you. Okay, even if you've worked overtime for a job before, okay, you might have seen that you've actually had to pay more in taxes. Okay, the more cash that you have just stacked up stationary, the more that it hurts you. And it transfers wealth from you to the state, which goes back to the government. So in 1920, 1 ounce of gold bought a high-end suite. And today, 1 ounce of gold would be about $2,600. Okay, so it still buys a high-end suite. And the gold stayed constant and the dollar collapsed. Okay, so keep that in mind. The gold stayed constant while the dollar collapsed. So that means that having your money parked in an asset class like real estate, people are always going to need houses. Gold, people are always going to be wearing jewelry. And other asset classes that stay constant and only rise up while the dollar collapses are going to be the asset classes that you want to focus on for the most part. So gold, people call it the ultimate hedge. A lot of the times, if you pull up the chart, you'll see gold year after year after year after year heading in an upwards direction. Okay, it's not stopping. And due to the fact that something has to counteract the dollar. So gold is going to be the human standard that people just use whenever the dollar is crashing or the economy isn't in a good place. So here's why central banks buy it. And central banks are going to be the banks where me and you bank at. Okay, the banks that hold our fiat currency, where we can go pull out our money to pay our bills, go to the ATM, etc. And the fear trade. So gold performs best when real interest rates are negative. And that's when inflation is higher than bond yields. Okay, and central bank demand. So in recent years, China, Russia, and India have been buying record amounts of gold to de-dollarize their reserves. Okay, so they're trying to de-dollarize their reserves in a significant manner. Okay, buying less time storage for their fiat currency and buying more time on their actual currency by investing into assets. Okay, you're doing nothing but losing time if you have more fiat currency. So fiat currency needs to be thrown into the river immediately. Otherwise, you're wasting time. Think of theta on options, if you're familiar with that. Over time, on a stock options contract, the options expires. Okay, think of your fiat currency the same way. Okay, if rent over year after year after year after year gets more expensive, if 1 year a house cost $200,000, but then 5 years later it costs $500,000, that means that your asset class has to be in a constant river, each and every single one of them. Okay, all your businesses, your profit has to be being reinvested into that. More stocks, more shares, more cryptocurrency. Okay, buying more houses if you're in real estate, etc. Okay, buying more land, and you could do whatever you want with the land. You could farm on the land, pay people to host ATMs on the land. Okay, people could build stores on your land. People could build antennas, cell towers, etc. But when you own assets and you keep stacking up your assets, it gives you a multitude of opportunities to be presented in front of you for your money to just make you more money because you invested in the right things. So volatility. So gold is low, and it's not for getting rich. It's for staying rich, and it's wealth insurance, not a lottery ticket. Okay, so stacking up gold over time. A lot of people might buy certain jewelry. Okay, go smelt it, take it to the jeweler, whatever, and either the jeweler will give them an exchange rate for the gold. So you're going to have multiple ways to invest in the gold too, which we're going to talk about. If you don't want to go the actual physical gold route, you're also going to have the ability to buy things like shares, etc. So let's jump into it.
So silver is going to be the industrial hybrid. So it's the green energy paradox. So silver is unique and it acts like money during crisis, but trades like a commodity during booms due to massive industrial use. So as far as conductivity, silver is the most conductive metal on Earth, and it's essential for electronics, 5G, and EVs. So for modern technology, silver is going to be needed. So silver is also going to be something you could invest to too. If you ever see a pullback on the charts or anything like that, silver is going to be an asset class that goes up year after year after year after year very confidently, especially while the dollar is collapsing. And let's talk about the solar boom. So photovoltaic cells, okay, solar panels, consume massive amounts of silver. As the world goes green, demand explodes, okay? So photovoltaic, okay, that's just solar panels. Solar companies are booming all over America, all over the world, and other countries as well too. Okay, especially countries with less green, less trees, taking advantage of that solar energy. So seeing silver going in an upwards direction year after year after year would make sense. Try to plant your seeds with things that make sense with the future, whether it being putting smiles on people's faces or helping people work throughout the day by day. Silver is needed in absolutely everything. And let's talk about the gold to silver ratio. So it's historically about 15-1. So 15 ounces of silver will give you 1 ounce of gold. And today it's often 80-1. And many argue that silver is undervalued relative to gold. And we'll see how that starts changing, especially during the AI era. When we start seeing robots and certain things start getting developed, the use of silver could go up in an industrial rate. So there's going to be two ways to invest. So you could either have a bunch of bars, whether it be silver bars or gold bars, stacked up. Some people do that, put it in a safe or leave it with the bank, etc. Some people also have jewelry, buy Rolexes, Audemars Piguets, Pateks, certain chains, real Cuban links, whether it be it bracelets, chains, etc. And some people take it to the smelter, melt down the gold, take that to the jeweler, and then you can go ahead and get some money for that. Or you're going to have the digital way, which is going to be via stocks and ETFs. So you could buy shares that represent gold. So in the stock world, it's going to be the GLD. So if you want to buy gold shares, you'd have to look up GLD. You could also buy gold options as well too. I have some recaps posted on my channel of some wins I've taken on that. Used to trade that a long time ago. And SLV is going to be for silver. And then for miners, as far as the mining industry, in order to mine the asset classes of gold and silver, you can look up GDX. And the pros of them have very high liquidity. A lot of people trade gold, from Forex traders to stock traders, options traders to futures traders. Golden is extremely, extremely popular asset class that's traded. It's low fees. It's easy to hold in the Roth IRA as well too if you just want to buy shares and hold. And the cons, you don't own the actual metal. So if the fund fails, then you have a paper claim, not actual gold. And as far as investing in the miners, it gives you leverage. So if gold is up 10%, miners might go up 30%, but they have risk as far as fuel costs, strikes, and etc. And the physical side of everything, you have no counterparty risk, total privacy, and it's useful in extreme disasters. That can be true and also not true. Your house could burn down, etc., and then it could be hard to get to the gold bars. The gold could maybe survive depending on how long it's in the fire, but still, that could be relative to a lot of cases. And cons, you got to worry about security. Hey, you can't be letting everyone know that you got a whole bunch of gold bars stacked up. That's not going to be ideal. Okay? You got to keep that very private between just you and your family. And storage issues too. When you start stacking up more gold bars, having a safe might be hard if you're trying to move houses or something like that, etc. Okay? And it could be hard to sell quickly. You got to go to the smelter, melt it down, and then go to the jeweler, get an exchange rate on that. And they might give you a lower price than you might actually should get because they're trying to make some money too. You know, it's the world. We're all trying to make some money. And tax. So it's often taxed as collectibles too, which is a 28% capital gains in the United States rather than stocks. So the strategic allocation. So how much is going to be enough? So most financial advisors suggest precious metals should be a hedge not your whole entire piece of the pie. So be conservative, 5%. Okay, it gives you just enough insurance to sleep at night. If you want to have a couple of gold bars in real life, then that would be fine too. And just keeping your asset classes divided in certain scenarios could really help you, especially during hard times. You might not have access to the internet, and you might need to go take the gold bar to someone who could exchange it for either some fiat currency or a car or just an item that you need. So having multiple sources of backup plans for your income is really, really going to help you. And gold pays no dividends if you do just have the actual gold bars. It just sits there. So try not to just invest 100% of your money into gold, or you're going to miss out on compound interest. And not even interest, but just compound equity curve just in general. Whether you invested into a stock that goes up year after year after year due to the fact that it's just making tons of profitable decisions, then you don't want to miss out on that. If you have one gold bar, 10 years later, if you don't do anything, if you don't get up and keep grinding and keep hustling, you're not going to have any more gold bars. Okay? But if you invest and put $1,000 into a stock, 10 years later, you could have did nothing and come out with $100,000. Okay, so having your asset classes divided is really going to help you. But there could be a time where you need to pull all your money out of your stock account and you have gold bars and you can exchange that, put it right back in your stock account. So there's going to be different scenarios and different floats, especially jewelry too. If you have any real gold jewelry that you don't care about, I would think about smelting it. Gold is extremely, extremely valuable, and just keep that in consideration. So is it a good hedge? I'm going to go ahead and say yes, but here's to clarify your goal. If you want to get rich, then focus on stocks, business, crypto. And if you want to stay rich and have protection over your purchasing power over decades, gold is going to be an extremely, extremely good standard. And if you want a speculative play to invest into, you could play gold futures. Gold is on Forex. Gold has stocks and shares you could trade. And same thing with silver too. So you could just make your decision in order to protect you over time. Take a look at the chart before you trade. If you're struggling with what to invest in, head over to Stackmode.net. Stay prayers to God. Keep grinding. Catch you guys in the next one. So if you've ever seen your portfolio down and noticed gas, groceries, etc. getting more expensive, what's the cause of everything? It's going to be inflation. It's the silent thief. And most people think that inflation just means prices go up, but it really means that your money is worth less and it's going down. The 7% inflation each year turns $100 that you own into just $93 of real buying power, even if your account balance haven't moved an inch. And when inflation spikes, the market reacts like a toddler with no nap. Growth stocks drop, companies can't hike prices fast enough, and profit margins get squeezed. And suddenly those charts are nothing but red candles heading in a downwards direction. But here's the part that nobody talks about. Inflation doesn't destroy every portfolio equally. It's about what you're invested in. Some assets actually thrive in the chaos. Commodities, real estate, energy plays, and even those boring dividend giants that simply pass rising costs straight to consumers. I'm going to go ahead and break down exactly what inflation is, and let's understand it, class, inshallah. So, the term inflation, you guys might have heard of it in school, around, you might have heard your parents talking about it, seen it on the news, etc. We're going to want to break down exactly how it causes other prices to go up, whether it be it on goods, etc., and how it affects stocks and stuff like that as well too, and how it can affect your portfolio. So, what is inflation in the first place? So, too much money and too few goods. So, in life, things work off of two things: supply versus demand. So, that's how things become valuable. So, if there's a lot more demand than supply, then that means that something is going to be valuable because people want whatever it is, which is why it's in demand, but there's not a lot of supply of it. Why? Because people are buying up all of it. Okay, so supply and demand are going to be the two factors that come into play when we're looking at inflation, or even just understanding how humans trade or an economies work in general. So too much money, but too few goods. Okay, so inflation is the rate at which purchasing power drops. It means that your dollar, so your US dollar, buys less today than it did yesterday. Okay, so whatever your fiat currency is, whether you're using the euro, US dollar, etc., inflation is the rate at which the purchasing power drops, meaning that your $100 might not buy you the same amount of goods as it did 10 years ago. Okay, so the demand pool. So everyone has cash and wants to buy the same limited items. Okay, so that's why prices go in an upward direction and cost pushes. So let's say materials, right, such as oil and wood,
they get expensive. So companies raise prices in order to survive. And the result that comes out of play is that, let's say you'll need $1.05 today to buy what cost $1 last year. And then year after year after year, it keeps going up. So it might start off as $1.05 today, but then 5 years from now, that same item could be $2. Okay. So if you're buying an item for $2, which you did for $1 just a couple of years ago, okay, you're now paying double the price. Okay. So unless you doubled your income, then you have to be ready to, one, subside your income for certain scenarios too. So if goods are getting more expensive, but your income hasn't increased, you either got to A, increase your income, or learn how to rebudget your current income. Okay, that's just how inflation works. So for example, just to break it down, in 1950s, let's say a burger, right? Let's say it was 10 cents. Okay. And then today, 2025, 2024-ish, okay, let's say something's $8. That's happening because more dollars have been printed. The more dollars that get printed and created, the less valuable it becomes. Okay. The reason why diamonds, gold, or even take Bitcoin example, are going to be valuable resources is because they are limited. But take the dollar, all they have to do is go up to the printer and keep on clicking print, and dollars will continue to spawn. So yes, we need dollars in order for the economy to flourish and for us to barter at a successful rate. But if humans continue to lead by their flesh and think that printing more dollars will solve everything, then humans will continue to pay certain consequences, such as dealing with more mental stress for having higher real estate prices, higher grocery prices, higher gas prices, etc. So how do we measure inflation in the first place? We got to take a look at the economic news event results. So let's go and let's jump into it. So let's talk about CPI. CPI is going to stand for Consumer Price Index. So for example, let's take a hypothetical basket of goods: eggs, gas, rent, and clothes, right? The government is then going to check the price of the basket of assets that people need in order to see if it got heavier. Okay, so that's what the CPI report is going to measure. A lot of the times after the CPI report occurs, you'll see a substantial move within every single market, whether it be at the crypto markets or the stock market. Okay, and then we're going to have PPI. Okay, PPI is also going to be very important. PPI is going to stand for Producer Price Index, and it's inflation for factories. So for example, if it cost Apple more to make an iPhone, okay, then that means the PPI would be up. Okay, and they will eventually charge you more. Okay, which means that the CPI, Consumer Price Index, would be up. Okay, so if it costs Apple more to make an iPhone, the Producer Price Index would be up. Why? Because Apple is the producer. Now, if they're charging us, the consumers, more, then the Consumer Price Index, the CPI, would go in an upwards direction. Okay, so core inflation at the baked center of everything. So CPI minus food and energy, right? Consumer Price Index. So why? Because food and gas prices swing wildly. Okay, and the Fed prefers core to see the real trend. Okay, so looking at the core inflation of everything is really going to be a much better statistic to look at when it comes to how the economy is actually doing within the full broad picture. But looking at every single news event, such as the rate changes, etc., are really going to help you, give you a good measure of how the economy is standing up and a direction of which the market could potentially head to. All right, let's talk about the melting ice cube with everything. So cash is a liability. Okay, so cash is a liability. Okay, this is Stackmodechris talking to you guys right now on some personal stuff. Okay, ignore the presentation for just a second. You guys should not be spending your cash. Okay, you need to be spending your cash to pay off credit. That way you're going to be able to get more credit and you're going to be able to spend that. Okay, you need to be investing all of your cash. Okay, you should not be spending your cash. Okay, you have to understand that it's a trap. Even when it comes to certain things like taxes, even if when you start touching M's, 6 figures, 5 figures, etc. Okay, if you just save your money and just sit on it and don't invest your money into something that's going to be bringing you into more income, okay, you're going to be getting destroyed on taxes. Why? Because you're just holding more still cash. You're not benefiting the economy and you'll get punished for that. Okay, so please, cash is a liability. The only reason you should use cash is to clear your credit and to build wealth. don't hoard cash. Don't hoard cash in your walls. Don't hoard cash in your bank account. Okay. Your checking account should be pretty much empty. Okay. Because why aren't you invested in the assets? Okay. You should have your life together. You should have your credit card. Okay. You should be able to survive off of that. Okay. When it's time to pay off your credit card, take your assets. Okay. When you have your profit, take some off the top. Okay. And you're going to be able to pay off your credit card and keep that cycle and flow going. So your money is infinitely going to be flowing in a river. Okay. The moment you pause your money, okay, the moment struggle starts to seep in. So I'm telling you, keep your money flowing on a river at all times. So a lot of people think hoarding cash is the play. Okay. And I know I'm Stackmodechris, but I'm telling you guys, if you're going to stack up into investments. Put your cash into investments. Don't just sit on your cash. Don't be having your money on just to put the money phone up to your ear and post on the gram. Oh, that's corny. Okay. Put all your cash into straight assets. I don't care if you do real estate, Bitcoin, stocks, doesn't matter. Some of you dividend ETFs. Okay. So many different avenues, whatever you're comfortable with. But I'm telling you, if you want to help your family, even if you die right now, you still want to be making sure some money is being generated, but you can't do that if you just have 100,000 pause in your bank. Okay. But if you have 100,000 in an asset, your family could eat forever off of that. You have 100,000 parked in a dividend, your family could eat forever off that monthly income. But if you have 100,000 parked within a Chase account, Chase is just going to take that money and go trade with it themselves. Okay. So understand that cash is going to be a liability under every single scenario. Cash should be used to pay off credit and invest into assets. Don't get trapped. Okay. So let's say, for example, right? And this is why God says interest is haram in the first place. It's pretty much useless. Okay. So try to invest your money into things that are going to give you a positive equity for curve, because things like a 2% APY stands for annual percentage yield. Okay. So trying to put your money into a account that gives you 2% per year, 3% per year, 4% per year, it's pretty much going to be all of your waste of your time, especially when inflation comes into play. You have to learn how to increase your income, especially if you're going to plant your income, at least plan it into something that's going to give you a much higher percentage yield at the end of the year. Okay. So any type of small percentage APY account, personally, I'm going to tell you, it's just not worth it, truthfully. Okay. So for example, let's say you had a saving account giving you 4% APY, right? And inflation is hitting at -6% each year. Okay. The real return is going to give you -2%. You're poor. Okay. You're poor in every scenario. So I'm telling you, keeping your cash inside of your bank account is a trap. I'm telling you in every single scenario. If you don't believe me, you can go look at your own economic data. But the fact that things only get more expensive means that you need to up your income. Okay. You need to up your income. And in order to do that, your cash needs to always be moving in the river. If you want to have your cash inside of the desert field, that can be you. But if you want to have an easy time in life, I really recommend you guys put your cash inside the river. You must invest in assets that grow faster than inflation to break even and to even see any type of profit for yourself, your kids, or your family. So get in your bag and use your cash, throw it into assets. Don't keep it still. So let's talk about the Fed's brake pedal. So fighting fire with ice. So when inflation gets hot, the Federal Reserve raises interest rates, right? Which means borrowing gets more expensive, mortgages go up, credit cards start going up, okay? And spending starts slowing down. People start buying fewer houses and cars, which means that demand drops, okay? Prices start cooling down. And in the long run, if people aren't buying products, then these products that are created by companies that are listed as IPOs on the stock market would not be benefited from that. Okay, the more products that are being bought for a company means that higher earnings reports are going to go ahead and be reported for those companies. Better earnings reports, a lot of the chances it is for that company to keep breaking into new all-time highs repeatedly, causing it to go in an upwards direction. But if people aren't buying any items from these companies and people aren't being consumers, then the stock market could head within a downturn due to the fact that the money is not flowing in the ecosystem as rapidly as it should be. Okay, so as soon as consumerism slows down, then the stock market within the short term becomes affected by that. So let's talk about impact on tech versus value, right? So growth stocks, let's talk about tech. So a bad effect, right? So these companies promise money 10 years from now. So when inflation is high, money in the future is considered kind of worthless almost compared to money now. Okay, so investors sell tech. Okay, but then you're gonna have like value stocks. Okay, companies that sell certain boring things make cash now. So they perform better when rates rise because they have pricing power. Okay, so it really depends too. When certain economic data reports come out, certain stocks are going to get a lot more affected than others. Okay, take like a Build-A-Bear, for example. Okay, that's a very consistent stock that goes up year after year after year after year. Okay, and it's not really based off of the future value. Okay, it's just people going to the mall and building cute bears, couples, kids, etc. Okay, but tech stocks, they are focused and based off of intrinsic value due to the fact of what they do for the future and how they innovate the future. Okay, so not saying either one's going to be better than the other to invest in, but when it comes to certain periods of inflation, if no one has enough money to buy certain expensive pieces of technology, etc., then a lot of companies will suffer. But then companies who just sell certain things like food might progress during periods of inflation. So it really depends on what time period you're in, which is what's going to determine what batch of stocks are going to be performing the heaviest. So you might ask me, Chris, how do we avoid inflation? Okay, what do we do? So commodities, real estate, and things like Bitcoin are going to be a really, really good way in order to park your money due to the fact that these things are going to be worthwhile and useful a lot of the times. People are always going to need a house. Okay. The reason why people invest into Bitcoin is because it gives you borderless transactions. And especially now, as times start progressing a lot more, especially US Americans are more open to traveling to other countries. So instead of having to take their US dollar and put it through transfers, just being able to spend that Bitcoin all around the world gives us a lot better suitability as humans. And then we're going to have commodities. You know, you're going to have energy, gold, silver, copper, etc. Physical things that people are going to be able to buy. So let's break down what these all mean. So commodities, right? So commodities. So if the price of stuff is going up, then owning the companies that produce the stuff is going to be a direct hedge. Okay. So any type of gold mining companies, etc., especially, okay, because gold is going to be a asset that especially goes up when economy is in inflation. Okay, due to the fact that it's something that's going to always be useful and it's a limited resource. Okay, now let's talk about banks. So banks can charge higher interest rates on loans when the Fed raises rates, which potentially increases their profit margin. So be aware of that. Okay, and real estate. So rents tends to rise with inflation, and fixed rate debt gets inflated away. So your mortgage payment stays the same, but your income usually rises. Okay, so keep all of that in mind too. So pricing power is going to be the secret weapon for everything, honestly. So can they raise prices? So the ultimate stock market defense is holding companies that can pass costs to customers. So people buy iPhones even if they cost $50 more, right? Due to the fact that it has a high pricing power. Okay, or take a commodity product. Okay, if brand A raises the price of white t-shirts, then you would buy brand B, okay, giving it no pricing power. Okay, but when you're investing into certain companies that have exclusivity, okay, certain companies that only do what they do and puts a smile on many humans' faces, then even if inflation were to occur, a lot of people would just see that as an opportunity to buy as the market going downwards. Okay, so especially certain tech stocks too that still have a lot of future value and have a lot of expectations to change a lot of things in a lot of ways. You know, if they're going in a downwards direction, people are going to look at that more of an opportunity rather than, oh, the stock market is failing, etc. So the bottom line for everything, just wake up, pray to God, be a disciplined person. I want you guys to look in the mirror, feel confident, feel proud of yourself for what you got put up. Okay, feel proud of yourself knowing that you can handle your responsibilities, knowing that you can help your family if things come into play. Okay, don't let your cash melt and don't let it freeze in your bank account either. Okay, own productive assets. I don't care if it's real estate, crypto, shares, dividends, whatever. Find your bread and butter. And if you're struggling to see what you want to invest in, head over to stackmode.net. Stay prayed up to God, keep grinding, and I'll catch you guys in the next one. Peace.
Stocks versus futures. Let's go and let's talk about it today. What's the difference and which one's better? So I'm going to tell you guys once. So stocks, they're going to be more for your long-term investing, but stocks also have something called options. Okay, options are going to be where you can purchase calls, which is meaning that you can pretty much get paid based off of predicting the price direction. So if you think that price is going to go in upwards direction and it does, then you'll make some money, inshallah, if you buy a calls options contract. If you think that price is going to go in a downwards direction, right, and you are correct, then you'll get paid if you buy a puts contract. Options also have expiration dates. Okay, so you can buy like a year out, months out, weeks out, and the further out the contract is going to be, the more expensive it is. Okay, then for stocks, you're also going to have shares. Okay, shares, they're going to go ahead and let you just long-term invest for the most part. You can day trade shares and stuff like that too, but it wouldn't be better than day trading options, for example. Options has a lot more leverage, okay, but it also has things like time decay. So options are going to be used for quicker trades than shares. Shares you could hold for like 10 years, for example. Okay. Options trade, a lot of the times you won't really hold it for more than like a year. Okay. So yeah, that's really the difference. And then we're going to go ahead and have futures. Okay. I'm sure you guys have heard of futures. Futures, that's really going to be heavily for my day traders as well too. Okay. And that's because the margin on futures is a lot different. So what margin is going to be the amount of money required in order to play futures. So let's say the ES contract, right? Let's say the day margin, let's say it requires $500 in order to open one contract. Okay, so in order to pretty much put down a trade with one contract, you need at least $500 in your account. Okay, and in order to hold the trade overnight, you need the full margin. Okay, and let's say the full margin is around 2 bands. Okay, if the full margin is 2 bands, then you need to be making sure you're having choke. Because if you don't have enough money on, then you're going to be out of luck. And if you don't have the full $2,000 and you're trying to hold overnight, your account can be liquidated. And this way you are going to actually owe the broker money, because futures is a heavily leveraged asset. So you're pretty much using the broker's money in order to trade. Okay, but you're just trying to have the minimum set at least to open a position. Okay, so both have their pros and their cons. Futures, on the other hand, don't have any time decay. Okay, futures, you can go ahead and like I said, if you have to have your full margin if you want to hold overnight. But on options, what can happen is, like, if your price isn't moving fast enough and you have a less time contract, your contract could be getting like eaten up or destroyed, right? Versus like futures, no matter the time, your contract is going to move linear. So it's going to move 1 point up or 1 point down consistently the whole time. Options, there's a lot of factors and stuff like that that can change the profit and things like that. So let's talk about stocks in the first place. So stocks give you ownership in shares of a company. So say you opened a company, right? And let's say you open stock company, okay, for example. Okay, so what's going to happen is you're going to go ahead and put it on the IPO, okay, initial public offering, okay, and then there has to be someone who buys all the shares in the background, a lot of background stuff that goes on in order for the stock to be available to the public. Okay, it's going to go ahead and hit the stock market. Once it hits the stock market, people like me and you can go ahead and invest into it as long as it's on our broker. Okay, and investing in the stocks, okay, via shares, let's talk about that first. So shares, they're going to go ahead and let you own a percentage of the company, kind of. Okay, so buying 100 shares of Apple at $150, for example, gives you partial ownership and potential dividends. Okay, and you can go ahead and invest in any stock that's available on the New York Stock Exchange and invest in companies that you believe in. Okay, any company that you think is strong, that you believe in, you've done the technical research on. If you feel like you want to invest into it, you can go ahead and make some money by pretty much investing in the future. So get in your bag, hop in your bag, stack up your money in. Don't be blowing it, doing anything on the block. Stay down and then invest and then go ball out later. Promise you. Playing it smart is going to help you guys a lot in the future. And let's talk about what futures are. So futures are going to be used for my day traders a lot of the times. So you can actually play both. Okay, you don't have to just stick to one or the other. What you can do is actually use your futures profit and put it right back into shares. So you can do anything like that. When you just throw it right back into shares, you throw it right back into the stock market. Your day trading profit, let's say you make $1,000 in the day trade. I like to personally take 50% of whatever I make, okay, and put that back into my account. So I'm going to keep $500 in the account. Okay, so my account's going to keep growing over time, and I'm going to go ahead and have $500 in my pocket. Now with that $500 in my pocket, I'm going to take 30% off, okay, for taxes. Okay, take 30% off for taxes. Okay, make sure you guys are paying your taxes every single year, especially once you start getting profitable. You don't want to get in any tax debt or anything like that. Just take care of your business, stay on top of everything, and don't be falling behind. Be a real boss. If you're going to call yourself a real boss or a real businessman, you need to really be doing that. Okay, And futures, they're traded on futures exchanges like CME or CBOT. And they're used for commodities like indices. Indices are going to be things like the NASDAQ 100, also known as the NQ, the ES, also known as the S&P 500, YM, also known as the DIA. Okay, those are going to go ahead and be things set like that. Okay, and commodities too, such as like oil, for example, CL is what the symbol is. Natural gas, NG. Okay, you're also going to have things like wheat you can trade. Certain Bitcoin futures you can trade. Okay, Ethereum futures you could trade. Okay, a lot of different futures you can trade. And once again, these are going to be things that you could trade that are heavily leveraged with no time decay. But make sure you're looking at the day margin and full margin on your broker. If you don't have enough money to trade futures and your margin goes underneath the required amount to open your contracts, you can lose all of your money easily. So please do your research. Please understand everything before you hop into anything. So if a trader agrees to buy 1,000 barrels of oil at $70 a barrel for delivery in 3 months, okay, so you can buy futures like that. So futures, and there's like physical futures, and there's also just strictly virtual futures, like the trade of 8 futures, for example. Ownership. So stocks equals ownership. You can hold stocks for like 50 million years. Same thing with futures contract, but you have to have the leverage. And leverage changes with news too. So if you didn't know that, the full margin, okay, actually changes with news. So make sure you're being aware of that. So as news occurs, your full margin is going to go ahead and change. It means you're going to need more bread. So if you don't have enough, that's going to be on you. So your time frame. Stocks can be held pretty much indefinitely. Futures have expiration dates though, is the thing. Okay. So you can hold a futures contract for like some months, but they have expiration dates like every few months. Then you got to roll your contract over. Okay. It's called roll, and rolling your contract over is when the contract swaps to whatever new month is going to start. And yeah, you're going to have to get into a whole new contract again. Okay. So leverage. Futures uses high leverage. So does options though too. But futures it's a little different. And stocks typically don't for the most part as far as shares. Okay. But options, the way it works is leverage, but options, you have the ability to like sell, and it's a lot more complicated, a lot more intricate. But as far as futures, it is just rawly leveraged due to the fact that margins required. So stocks, you can take your day trading profits, investing in the stocks for long-term growth. So your bread can always be making bread. Okay. As long as you got that bread in your pocket, you're going to be trimmed. Okay. So dividends are going to be what's paying you, and less volatility too. Okay. So your volatility, whatever's going on, you don't really have to worry about that too much when it comes to just investing in shares. Your P&L is not going to be swinging all over the place. Okay. If you invest in shares, your P&L is going to be pretty consistent, especially you invest in good stock. A lot of the times, inshallah, your P&L is just going to be an upward trajectory year after year, year after year. So trade-offs. Stocks are simpler, but futures offer flexibility, but with complexity. So if you understand it, you can be a really good day trader, and especially if you understand your smaller time frame structure and stuff like that, break and retest, etc., your futures trading can be extremely successful, inshallah. So let's talk about the risk comparison. So stocks. So the market risk, company-specific risk, lower leverage risk. So futures have high leverage, okay? So the losses can be amplified. Margin calls, once again, can happen, okay? And contract expiration risk are going to be a thing as well, too. So for example, if a stock investor loses 10% if shares drop, a futures trader could lose their entire margin on a 10% move, okay? So especially when there's heavy news candles, make sure you guys are playing with your stop loss as well, too. Don't be losing your bread doing fry stuff. Put your stop loss down. Don't be playing with ego, overconfidence. Put your stop loss down, especially if you're going to be trading some futures. Put your stop loss down. And what your stop loss is, let's say, for instance, you bought at $200. If price goes to $190, it's going to automatically close itself, okay? And this way, you're not going to get emotional when price starts dumping down and you're in a long, like, oh man, I pray that price sweeps up. You need to just stick to your logistical plan, okay? Be thankful to God that you even got a chance to hop on the market and hop off. You need to take your L like a man or a woman and push on forward. Take that L and turn it into a lesson, and don't let it happen again. If it happens again, it's completely on you, okay? Stop being fried, okay? There was times I had to learn, times I was doing the same things over and over again, holding me back from profitability, okay? I had to get right, okay? I had to lower my ego,
had to get humble. I had to realize that the money I was making was actually good money. So instead of me overholding a trade, cooking my trades, okay, holding way past take profit, trying to make some bands, let me take this money that I just made here from the market, okay, and let me take it consistently. I'll wait, and then my contract size will increase, okay? So get rich slow. Don't just be putting on mass highs just because you can on futures. Take your time. Keep your risk management in place. Stay between 1 to 10% of your account per trade, okay? And make sure you guys are looking at your margin requirements. I cannot stress that enough, okay? Because a futures broker can sue you if you don't pay them, okay? Or if you don't have enough money in order to be trading, okay? I don't want you guys to get sued. That could set you back even further. We're here to make some bread, not lose it, inshallah. So, futures, if you're an active trader, especially a day trader, someone who trades like a couple times a week, futures are going to be amazing, okay? And it really just depends on the goals, risk tolerance, and the market knowledge. For example, a retiree might prefer stocks for stability, and a commodity producer uses futures to hedge prices, okay? So it really just depends on what you want to do, how you want to trade. And stocks, they pretty much give you that ownership. You could hold a stock for 30 years, for example. But futures contracts, they have expiration dates, so you got to swap to the new contract and roll it over, okay? So keep that in mind and keep the expiration dates in mind, okay? Futures involve higher risk and higher leverage, and you can get sued a lot of the times on shares and options, especially if you're on a cash account. You're going to be good, okay? You're going to be able to just play with the amount of resources that are in your account, and you can't really go past that, okay? Do your research, okay? Assess your risk tolerance. I love you guys so much. Step right up to God. Keep grinding. Catch you in the next one.
Enjoy more ways to save at Kroger, like low prices in every aisle. And you can clip and save more with digital coupons in the Kroger app. Plus, you can earn fuel points to save up to $1 per gallon at the pump. So it's always easy to save big. Kroger, fresh for everyone. Savings may vary by state. Fuel restrictions apply. See site for details.
Save big on your favorites with the Buy 5 or More, Save $1 each sale. Simply buy 5 or more participating items and save $1 each with your card. Kroger, fresh for everyone.
Thank God. Let's go and let's talk about what this means for the future of trading and how new traders can go ahead and jump into the market a lot easier now. So let's understand what the PDT rule even is. The pattern day trading rule, as defined by the Financial Industry Regulatory Authority, the FINRA, it was a crucial regulation that governed day trading in the United States. Instituted in 2001, it was created to protect inexperienced investors from the substantial risk of frequent leverage trading during the dot-com bubble. So they didn't want people just throwing in all their bread, losing it all for no reason, okay? When a bunch of new companies were hitting the stock market, okay? So the pattern day trading rule was pretty much created in order to protect people. So the $25,000 equity requirement. So to be classified as a pattern day trader, okay, PDT, you need to execute 4 or more day trades in a margin account within a 5 business day period. Nowadays, there's 2 types of accounts. You have cash accounts, okay, which lets you trade strictly with your own money. And then there's margin accounts, okay, which lets you trade with some borrowed funds when it comes to the broker, okay? And once flagged, your account was required to maintain a minimum equity of at least $25,000. And if the balance dropped below this, day trading was then restricted. And what's a day trade in the first place? A day trade was defined as the purchase and sale, or sale and purchase of the same security within the same trading day. So let's say, for instance, I purchased Stackmode stock for $30 a share, and I sold it for $34 a share within the same day. Let's say I did that all on Monday, okay? That is a day trade. If I bought Stackmode stock for $60 a share and sold it for $80 a share, okay, and I bought $60 a share on Monday and I sold $80 a share on Friday, okay, then that's not going to be a day trade, because that was days later I sold. I bought on Monday, sold on Friday, not a day trade. But if I buy on Monday, sell on Monday, that's a day trade, okay? So if you buy and sell within the same trading day, that's a day trade. And this rule applies to stocks, options, and ETFs. And the purpose of this rule: the primary goal was investor protection, and the rule ensured that traders engaging in high-risk strategies had sufficient capital to absorb potential losses, thereby protecting both the individual and their brokerage firm from financial instability. So the historic regulatory shift of 2025
So as of September 2025, FINRA's Board of Governors has officially approved amendments to replace the pattern day trading rule. Exciting. This is one of the most significant changes to day trading regulations in over 2 decades. And the move comes as a response to the rapid advancements in trading technology and real-time risk management capabilities of modern brokerage firms. So the fixed threshold is now gone. The rigid 25,000 equity requirement for day traders has been completely eliminated. This removes a major barrier for entry for retail traders. And retail traders, if you ever hear that term, it's just people who just want to get into the market. Okay, not like hedge funds, banks, or anything like that. Just individual investors. A lot of the time is what retail means. So individual investors and individual traders with small, previously unable to engage in frequent trading can now do it. So replaced by intraday margin framework. So the old rule is replaced by a more dynamic and flexible intraday margin framework. The new system applies existing maintenance margin rules to a trader's real-time intraday exposure, making it a risk-based approach rather than a capital-based one. And pending SEC approval. While FINRA has approved the change and must still be filed with and formally approved by the U.S. Securities and Exchange Commission, SEC, before it can fully be implemented. So traders should continue to operate under the existing PDT rule until a final effective date is announced. Okay. So FINRA approved the change, and we're still waiting for it to get approved. Implications for traders, a new era. The removal of the PDT rule represents a seismic shift for retail traders, particularly those with smaller capital bases. It promises a more accessible, albeit more complex trading environment. So lower barriers for new traders. So the most immediate and profound impact is the ability for new traders with accounts under $25,000 to execute frequent day trades without restrictions. This democratizes active day trading and opens the door for a new generation of market participants. More dynamic buying power. Under the new framework, buying power will be directly tied to the risk of positions a trader takes, and highly volatile securities or concentrated positions will consume more margin quickly, while stable assets will allow for more leverage. This requires traders to have a better understanding of margin mechanics before you lose all your money and blow your account. An increased importance of risk management. Since the fixed capital floor is now removed, risk management becomes paramount. If you don't follow your rules, if you're not disciplined, if you don't humble yourself, okay, if you don't wake up, pray to God, study the charts, work out, have a strict routine, journal all your trades, you won't be successful. Okay, you have to be extremely disciplined when it comes to this game. And it's about keeping up this bread, keeping up getting this money year after year after year. It's not about just making 7 figures in 1 year. It's about doing it again the next year, maybe scaling to 8 figures, 9 figures, and pushing yourself further based off the discipline consistency. Risk management is going to become paramount. Okay, the more power that you have, the more power you're going to have to control. And traders need to be vigilant about their intraday exposure to avoid margin calls or forced liquidations. Forced liquidations is where the market is going to pretty much automatically close your position for you. And if you don't pay the money back that you owe the broker because you're paying with leverage, which means they're giving you capital, then you could be subject to court fees and they could owe you money, or you have to owe them money. Okay. So diving deeper into the intraday margin rule. The intraday margin framework is a sophisticated replacement for the outdated PDT rule. Instead of a blanket restriction, it uses real-time metrics to determine a trader's capacity for risk. And here's how it works. So real-time calculations. Brokerage firms will now calculate and enforce maintenance margin requires throughout the day. This provides a more accurate and responsive measure of a trader's risk level. So position-driven leverage. Your trading leverage will no longer be static. It will fluctuate based on the specific positions you hold, their volatility, and the concentration of your portfolio. So for example, a highly volatile tech stock will consume more margin than a blue chip utility stock. And the impact on different strategies. This can make strategies like scalping or fast-paced equity trading more viable for smaller accounts. However, it also introduces a new layer of complexity, requiring traders to understand the specific margin impact of each security they trade. So here's an example scenario, trading under the new rules. So let's consider a practical example of how the new intraday margin framework might work for a trader with a small account. So let's say, for example, Alex, right? Okay, let's use that name for example. Let's say Alex has a trading account with a balance of $5,000. He wants to execute more than 3 day trades in a week, which was previously impossible under the PDT rule. So in the old rule, Alex would only be restricted to 3 day trades. He could not execute a 4th one, regardless of the quality of the signal or his risk management, okay? Because it's 3 trades in a week. Now with this new rule, Alex can now make a 4th, 5th, or even 10th day trade, and his ability is no longer limited by a number of trades, but by the intraday margin available in his account. And his broker monitors his risk in real time. And if he takes a position that's too large or too volatile for his account size, the broker system will simply prevent the trade. So risk and key considerations for traders. While the new framework offers unprecedented freedom, it's not without its own set of risk. Traders must be prepared to adapt their strategies and mindset. You can be subject to intraday margin calls, where unlike the old rule where you were protected by a fixed floor, you may now face intraday margin calls. If your positions move against you, this requires immediate action and could lead to forced liquidations. And education is going to be paramount. Understanding concepts like maintenance, margin, concentration limits, and intraday exposure is now a non-negotiable part of a day trader's playbook, and a lack of knowledge could lead to significant losses. And firm-specific rules. While FINRA sets the regulatory minimums, individual brokerage firms are free to impose stricter rules, and traders must be aware of their broker's specific policies, as these can vary significantly. And the removal of the 25,000 PDT rule, it's really just a monumental step towards monetizing day trading for brokers so they can make more money. And it's a monumental step towards modernizing day trade regulations, making it more accessible for everybody. Okay, so God is good. It's an opportunity for you to come on the charts and make some money just by being disciplined. Make sure you get informed. Head over to Stackmode Network for all trading education. And this rule is going to make trading more accessible. Okay, it's going to bring more volume to the market. More people are going to start trading, inshallah. Okay, and it's also going to come with the increased amount of responsibility. With more power comes more responsibility. Okay, love you guys so much. Stay prayed up with God. I'll catch you in the next one. Keep grinding. Peace.
Quantitative tightening has officially ended, and trust me, this changes everything for investors. For the past few years, the Fed has been draining money out of the system, shrinking its balance sheet and putting pressure on stocks, real estate, and even crypto. But now, that pressure valve just opened, liquidity is flowing back in, and whenever liquidity comes back, asset prices don't just react, they move. But here's the truth that nobody tells you. The end of quantitative tightening doesn't automatically mean a bull run. It does mean volatility though. It means opportunity, and it means that the smart money is already positioning while everyone else is still confused about what quantitative tightening even is. So what does this shift actually signal for you? Expect easier borrowing, potentially higher stock valuations, stronger risk on sentiment, and most importantly, a window of time where early positioning matters more than ever. So let's figure out how we can plant our seeds, what quantitative tightening even is, and how we can learn how to invest. Inshallah. Let's go. Quantitative tightening has ended. All right, let's go on this breakdown how it's going to affect investors and the future of everything. So what was quantitative tightening in the first place? So quantitative tightening is the reverse money printer. Okay, so you know quantitative easing, right? QE. And that's when the Fed prints money to buy bonds. Quantitative tightening is going to be the exact opposite of that. Okay, for the last few years, the Federal Reserve has been destroying money to fight inflation. Okay, printing more constantly over and over and over and over and over again. Okay, and the mechanism. Okay, so it's when they let bonds that they own expire and don't replace them. Okay, and the result of that is cash disappearing from the economy. Okay, and the goal of it all is to slow the economy down to stop prices from rising. Okay, so quantitative easing is turning the water hose on to fill the pool. Okay, and quantitative tightening is sticking a vacuum in the pool and sucking the water out. Okay, so let's head over to the next slide. So the Fed cannot suck money out forever, or the system would go ahead and just break completely. Okay, so they're stopping or tapering quantitative tightening because inflation is cooling. Okay, the job is pretty much mostly done. And let's talk about the liquidity risk too. If reserves get too low, then banks will start to fail. Okay, and that cannot happen. The whole United States economy and infrastructure is based off of banks, companies, and money flowing through business owners. Okay, an economic slowdown, okay, they don't want to cause a massive recession for pretty much no reason. Okay, so the danger zone. So imagine braking a car too slow it down. Okay, and if you keep holding the brake after the car stops, you don't move. Okay, but if you brake too hard, you skid and crash. Okay, so right now the Fed is releasing the brake. Okay, That's all it is. So imagine braking a car to slow it down. Okay, if you keep holding the brake after the car stops, you don't move. Okay, and if you brake too hard, you skid and crash. So right now, all the Fed is doing is releasing the brake. Okay, that's it. All right, into the market. Okay, because money's no longer being deleted pretty much. Okay, so liquidity is the lifeblood of the market. It's easily how money moves around. Okay, and risk on. So historically, the end of tightening is a green light for risk assets. Okay, letting us know that there's going to be more money circulating in the economy, giving us a higher chance for our assets to head in an upwards direction, since A, more people will be investing into something with value, okay, or B, people will have more money to purchase things with value. So valuations. So with less pressure rates on PE ratios, okay, stock prices can expand and head in an upwards direction. Okay, and tech and growth. High growth companies like tech or AI companies usually benefit the most when money becomes easier. Okay, because then they're going to have more money to invest back into their company and circulating instead of having to be tight and restrictive with the advancements and innovations, especially tech and AI companies, because the whole point of tech and AI companies is to profit off of future innovation and psychology involved into it, right? Investors then stop fearing the Fed and start fearing missing out. Okay, they're like, hold on, quantitative tightening is, hold on, it's pause. What we got to do is put some risk on, put some money down on the table before market heads up to all-time highs without us. Okay, so when the Fed was selling, okay, you sold. Okay, so now the Fed is stopping. Okay, so the headwind is gone. Okay, the headwind is gone. Make your decisions. Plant your seeds for your asset classes. Okay, so you don't have to struggle in the future. Okay, the market can do two things: go up and go down. It goes up and it goes down. That's it. Okay, you're not playing an intricate math problem that you have to solve every day. All you have to do, for the most part, is invest in something that has future value and hold and be disciplined with your money. Okay, fight your flesh. You can't be indulging in things that you want to buy every single other day. Okay, stay down. So you're putting majority of your money away into asset classes. Okay, I'm not saying don't enjoy life. We are here only once. You know what I'm saying? Enjoy life. Do your little thing. Okay, get you some little food. Buy you some little clothes, live your life, do your thing. But it can't be that week after week after week after week after week. A lot of the time, you should just be staying down, planting your seeds for your family. All right. So over to the next slide. Supply and demand. So during quantitative tightening, the Fed was a massive seller or non-buyer of bonds. Okay, and this forced interest rates up. So quantitative tightening ending leads to less supply of bonds flooding the market. Okay, and bond prices should stabilize or go in an upwards direction. Okay, and yields should stabilize or go down. Okay, so the real world effect of everything is that mortgage rates are tied to bond yields. Okay, if quantitative tightening ends and yields drop, then mortgage rates could finally come down, making real estate and real life a lot more affordable. Okay, so the fact that quantitative tightening is being ended is a really, really good sign for the future of the economy. Okay, and this is really going to help the housing market, get a lot of people off the streets, okay, and really just help a lot of people out in the world, making life more affordable again, okay, because we shouldn't be stressed out every single day, you know, just trying to live our life, especially when we're already grinding hard. So let's go over to the next slide. Okay, the biggest risk of stopping quantitative tightening too early is that inflation has a chance to creep and come back up, God forbid, okay. So the mistake that happened in the 1970s, for example, right, the Fed stopped fighting inflation too soon, and it came back double the strength, ready to bite everything in the tail. Okay, banks crashed, companies crashed, CEOs crashed. A lot of CEOs and a lot of companies ended up selling their companies to other major companies to make up for the fact that they couldn't keep up with that recession crash. Okay, and the market bubble. So if market ends up going up too fast, okay, it creates a bubble that might pop later. Okay, it might pop later super duper hard, and the economy will face its consequences for that. So the currency risk, okay, the dollar might weaken if they print too much, okay? If it's too much of something, it's no longer valuable, okay? If something is everywhere, it's not valuable, okay? So just think of it logically. If something is everywhere, it's not valuable, okay? But if something is scarce, it's rare, okay? It's valuable, okay? So, though we aren't printing, okay, just stop the shredding. Okay, so watch the CPI, Consumer Price Index reports. That's going to be one of the most important reports that come out that's going to determine how cryptocurrency and the stock market wants to move. Okay. And if inflation ticks up, the Fed might have to restart quantitative tightening, and that would be super duper bad for stocks. So cash yields might peak. Okay. Try to lock in rates or move your cash to assets. Okay. Keeping your cash in that asset river, especially if the dollar weakens, then that means assets are going to become more valuable. Okay. Because people have to have some type of value in something. Okay. So once again, if cash gets weaker, then assets become more valuable. Okay. And the quality growth of everything. So look for companies with low debt that grow regardless of the economy. Okay. And it might be a good time to buy bonds before yields drop as well too, if you'd like. Okay. So review your cash position too. Okay. See how much cash you have and see what you can plant within your asset classes. Okay. Don't be scared of the market anymore, and keep an eye on inflation data is ending. Okay. Money is back. Okay. It's trying to get healthier. It's trying to flow back into the markets properly. Okay. And liquidity stabilizes, which is really, really good for the market, letting us know that there's going to be more money available, which means more money could be flowing into asset classes such as the stock market or the crypto market. Okay. And this gives us a chance for rates to likely stabilize or drop. Okay. And risk shifts from the Fed fear to inflation watch. Okay. So stay invested, stay alert, keep up with the reports, stay prayed up to God, keep grinding. Make sure you guys aren't buying any assets at all-time highs. Okay. I don't even care if it's real estate. Okay. Even if it has nothing to do with the charts. Don't buy any assets at all-time highs. Okay. Wait for the dip, buy, and catch the V sweep up. Okay. Stay prayed up to God, keep grinding, and head over to Stackmode.net if you guys want to learn how to invest. Peace.
Usually getting a phone for $0 is too good to be true. A hassle, but not at Verizon. Now, when you make the switch to Verizon, America's best network, you can get the new Samsung Galaxy S26 Ultra for $0. No drama, no hassles. No trade-in needed when you get a new line on an unlimited Ultimate plan. Talk about a no-brainer. Best network based on root metrics, best overall mobile network performance, US 2H 2025. All rights reserved. See Verizon.com for details.
All my day traders out there, there's going to be a completely different world to trading, and that's going to be long-term investing. Take some of your profits and siphon that back into shares of certain stocks that you believe in, into certain cryptocurrency plays, into ETFs that pay out dividends, so that you can generate passive income. Use your money as a tool, and that way you're always going to be using your money to generate some more money. Okay, so trading, it's really going to be more of a career, more of a wealth generating tool, as far as day trading, weekly trading, options trading, and just swing trading, closing position from between 1 day to a couple of months, 2 weeks. And the other one is going to be holding positions for year after year. There's also going to be some long-term tax benefits that come into play as well too. So you actually get some benefits for holding trades for over a year. So I recommend you guys have 2 portfolios, 1 portfolio for your day trading portfolio and another portfolio for your long-term investing portfolio. It's really going to help you break everything down. And when it's time to do taxes, you're going to be able to calculate and differentiate everything pretty quickly and easily. So let's jump into it. So class, even if you start making 3 figures a day, 4 figures a day, 5 figures a day off of day trading, don't lose yourself. Okay, it's really easy to be reset back to zero, especially after a season of like a long wing streak and market, say, for example, swaps the trend. Okay, you might get into some kind of ego horizons certain time, not being able to accept certain losses, especially after you just streak like that. So you had a really good month, you just won pretty much every single day of the one. And then when you take your loss, you might end up taking 2 or 3 trades, okay, losing 3 times in that day because of the fact you just won so many times. So your brain can kind of get skewed. This is why it's really important to be with God and really just be humble at all times. Focus on the discipline and just forget about P&L. Update your contract size as your P&L grows, of course, but you can't just think money, 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 money. Okay, focus on the consistency in the process and the infrastructure around the type of trades that you're taking in the first place. So once you start making your day trading income as well too, take 50% of that away. Okay, say you make $100 in a day, for example. Take that $50, okay, and then you're going to take that $50, whatever the withdrawal amount is, okay, or say you make $1,000 in a day, okay, then you're going to go ahead and withdraw $500 Okay. So that $500, you're then going to take 30% of that $500 and you're going to go ahead and put that away. Okay. That 30% of $500 is going to be for taxes. Okay. And then whatever you have left over of whatever your withdrawal amount is, okay, take 30% of that, put it away for taxes. And then whatever you have left over, or you can honestly just split it 50-50 if you want. You could go ahead and do 50% of your initial withdrawal profit and then break that down into half as well too. Split that into 2 separate accounts, and that way when you pay your taxes, you're gonna have some overhead money. So you can go do whatever you want, either reinvest it or ball out, do whatever you want to do, because your stuff is gonna be together. Taxes are paid, and anything that's overhead, you can either use to get further ahead or just spend on it if you want. Okay. And that's kind of going to be your reward account, especially when you have overhead after paying your taxes. It's okay to go ahead and ball out. You know, we're still only here for one life. So do that, especially in your tax account. You can use that as a reward for being on top of your finances. So when it comes to long-term investing, and that really means holding position for over 1 year, because remember, there's going to be long-term tax benefits for holding positions over 1 year. And the goal of that is really going to be to just build wealth, security, and you're not going to be trading your time for money at this point. Okay. In hindsight, you are, because you're going to be waiting for things to go up, but you're not going to be wasting physical human exertion in order to gain income. So at this point, your account's going to be built up. Let's say you have around 50K. Okay. Let's say you have $50,000, right? Inside of a ETF paying you dividends. Let's say that dividend pays you $2,000 or $1,500 a month. So if you have $50,000 invested, right? So that's a pretty average income, right? $50,000. If you have that invested into a dividend, say that dividend is paying you $1,500 quarterly. That's all of your rent, your expenses, etc. paid just because you invested. Okay. So you can actually get $2,000 a month for just being invested. So start working on your dividend portfolio, keep siphoning money into that. And once you have enough investment, the shareholders will pay you out what's called dividends, and you can make like $1,500 a month, $2,000 a month, and have your money put up securely and safely. So forget 401k, Roth IRAs, all this slow type of wealth. There's a lot of wealth you can really be building now. So stay down for a couple of years. You know, don't do anything, just work, grind. You know, get closer to God, work on your spirituality, and it's really going to take you on a long-winded journey, especially once you start touching the 6-7 figures. Your mind can really go aloof. Okay, so it's really important to just stay humble and keep reinvesting that profit into cycles. This way, you're not even going to get the chance to blow up your account in the first place. Okay, when you're taking that profit and constantly reinvesting it, and you have the mindset, you've trained yourself to understand, like, okay, money's just a tool. Like, I'm not just going to use this to go splurge and do X, Y, and Z. I could just get wealthier and then let everything pay for itself. Because when you get to a certain point of investments, you can pretty much live completely for free. And living for free is just no stress. You don't have to physically exert to pay your bills. As long as you have a certain amount of investments, you can live stress-free. You'll have money coming in at all times. You'll be making money every single second. So if you just stay down for a couple of years, couple of months, keep your head down, stay focused. Okay. All those friends telling you to go out, etc., that's not doing anything for you. Okay. If you want to end up broke in the future, that's fine. But if you don't want to progress, if you don't want to put your family in a better position, then go ahead and slack off. But for the people who do want to actually achieve their goals, get somewhere and provide for their family, stay down for a couple of years. Okay. No buying clothes, no buying jewelry. Okay. If you have a super nice car, like a premium, for example, okay? I used to pay premium gas. I used to be an idiot when I was around 18, 19. I had an Audi A4 and was paying premium gas during the height of it. It was around $6 a gallon, and I lived in Georgia. So I couldn't even imagine what gas was for people on the West Coast at that time, probably like $10 a gallon. So spending around like $190 or around $80 per fill up, it's really just wasting money, okay? Just driving around doing absolutely nothing instead of investing. Okay. And Bitcoin example, I made a mistake where I had tons of Bitcoin. Okay. I had around like 30 grand worth of Bitcoin and would just constantly spend it every single cycle. Would just spend it. So me not staying down, me not stacking up really resulted into me realizing, like, okay, you can set yourself back years if you don't plant your seeds. Okay, you got to think of investing like a garden. You got to really plant your seeds in the ground and let everything sprout and grow over time. Okay, But if you plant your seeds and say the tree gets big overnight and you instantly just chop the tree, how do you expect to keep getting fruit? How do you expect to keep growing from that? Okay. So even when you touch that big bag, you can't just chop down your tree. Don't just withdraw all of it and stop trading. No, you got to stay down. Don't get overzealous, reinvest it. And then you're going to be able to get to the point where you can pretty much live for free. Okay. And once again, living for free is going to be just being able to pay your bills, feed your family, and go on trips, etc., without any physical exertion involved. Okay. So work hard now. Okay. You don't have to physically exert yourself forever. If you do the hard work for around like 1 to 5 years, okay, hard investing, hard work, growing your business, growing whatever niche that you want to execute in, then you're going to be able to achieve the goals that you want to achieve, okay? It's going to be easy to jump into real estate from there, especially with all that capital from there, okay? And say you were to generate a large income, okay, and have a large savings amount. Say you were to chop down that savings and buy a house, for example. Say you wanted to buy a house or buy a duplex or a triplex, right? And rent it out to a family, okay? Or a couple families. Let's say you bought a multifamily, okay? If you use that profit and bought a multifamily, okay? Let's say the multifamily costed you like $300,000, $250,000, right? Okay, if you buy that and you use a good chunk of your savings and you still have money within your dividend investments, you're going to be fine. You're still going to be getting paid around $1,500, $2,000 a month from the money that you already have initially invested in, which is also stacked up on top of that. So just from your dividends alone, you're pretty much going to be able to live. So while your multifamily income is generating, while your real estate profit is generating, whether you do Airbnb, get a multifamily, whatever route that you go, okay, you're going to be able to survive based off of just the investments that you made in the first place. Okay, so it's really important how you spend your money, even just $1,000, right? Instead of buying the newest computer, the newest phone, okay, go invest, okay? Because when you're dead broke, when you end up flat, you're gonna be wishing that you could sell those items and restart over again. So don't do that, okay? Make the smart decision, invest. The reason why a lot of people are behind when it comes to bills and stuff like that, living paycheck to paycheck, is because they don't invest. Okay, when you invest, not only do you have your stash, okay, you have money that you can pull out and execute back into your bank account at any time. You have money that's generating you money at all times, pretty much. Okay, especially when you put down good trades, whether it be at options, futures, Forex, whatever, your money's gonna always be generating you money, okay? And then when you take that day trading profit, put it into shares, which are definitely gonna be always generating you money, inshallah, especially when you invest in good companies. Take Build-A-Bear, for example. Build-A-Bear, it does nothing but go up in a straight line. For example, the company just a couple of years ago, as of 2025, when this video is coming out, was around like $2 a share, okay? And it's had no dramatic pullbacks. It's a really low-key stock, but Build-A-Bear is a good company, okay? It's now at like $72 a share after this video. So it's just a good investment. And once you find really good companies to go ahead and invest in that provide future value to human beings, go ahead and invest in that. Put your money into that. You're not going to regret it. Okay, a large percentage of millionaires come from the stock market. Okay, so after your business goes up, after you start getting a nice paying job, whatever, after your income increases, invest. And this way you're going to be able to sit down and really just sit on your butt whenever you want. Okay, you're not going to have to physically exert yourself constantly for income. That's not going to be reasonable, especially as you get older. Okay, there's going to be certain mental things. Your mental is not going to be as sharp. Your body's not going to be as strong. Okay, so it's really important to invest. So this way you guys aren't going to have to rely on other people, you know, trying to rely on certain things like family and things like that. It's not always going to be the smartest and wisest thing. So you always want to just try and put yourself in a position to where you can provide. Okay, so if anyone falls short, you got them. Okay, so invest. So you be the one to stay down. You be the one to stay in the stack mode. So instead of you falling short, okay, and having to beg, okay, you be the one that's gonna take the sacrifice, okay, not go buy all the flashy things, really stay down, okay, get groceries, not be eating out, and not be doing things you shouldn't be doing. So this way, whenever things do get hard, you're gonna be the one to be able to take care of the things that need to be taken care of. So this way people don't struggle, okay? So just stay down, get into stack mode, and whenever anything goes down, you're gonna have the financial security, and it's not gonna break your bank, because things happen in life. Hospital bills, Okay, car crashes. There's a lot of things that just happen randomly in life, and you can't have rent coming up on the 30th, and then you have a $600 car repair bill. That's going to throw off all your calculations, and then you're stressing about that. Okay, but when you're investing, you have your money making you money at all times. If something like that happens, you're going to be fine. You're going to go dig in the stash, pull out some money out the stash. You're not going to be tripping. Okay, but when you're reliant on that calculated paycheck only, okay, you're not going to be able to grow within an exponential way. So this is why it's important to start your own business, because this way your income is going to be pretty much unlimited. When you start your own business, your income is based off of how much effort you put in. So however much a business makes is based off of how much effort they're putting in and how much they're helping society. And then B, invested portfolio income too. Okay, so when you invest income constantly, especially into certain things that are almost guaranteed to generate you a positive equity curve year after year after year, you're going to go ahead and subsede your constant income. And then you're just going to be way ahead of things. Okay, so if anything dramatic does happen in life, because life definitely does life, you're going to be cooling. Okay, you're going to be able to dig in the stash. You're not going to be tripping. So long-term investing, it's definitely lower risk for sure. Okay, I'm glad I went through all the day trading struggles at first. Okay, going through all the emotional highs and lows, making $1,000 one day, losing $900 the next day. You know, going through the emotional high and lows really teaches you emotional control. But as far as long-term investing, once again, there's people who are millionaires who barely look at the chart and just invest into just certain things. So certain ways, effort, especially when it comes to the market, effort is not going to always guarantee profit. Okay, someone who makes 10 trades a day is not going to be as profitable as somebody who just bought and hold something for 5 years. Okay, a lot of people who just buy and hold actually outperform a significant amount of day traders. That's because day trading is not something that's going to be inherently easy to get down. So I've been trading for around 2 or 3 years now, and I'll say April 2025 had one of my most successful day trade months. I took 30 trades, won 25. Okay, and the 5 trades I lost was just not looking due to news. Okay, so those were my fault. So that month really taught me, like, okay, if you day trade, you can win pretty much every single day if you wanted to. As long as you're taking the right type of setups, you're waiting for confirmation. I personally trade break and retest, and you're waiting for key levels to be broken, then yeah, you could almost win every single day when it comes to the day trading aspect. Now, how long your day trades will be, that's also going to be an inherent question. You might be closing like in a couple of minutes. But you're going to be trading between like hours and days. That swing trading area, that's still going to be kind of within the day trading space too. So I'd say anything that you're closing less than a year would be like considered within that same environment. Okay, so be careful with that too. It can come with extreme risk, because especially with futures and Forex, you have a lot of power. You can just instantly click buy and sell constantly, and your money's going to fluctuate. Okay, well, depending on the amount of leverage and ticks amount that you have on, your money is going to go ahead and fluctuate. So the risk is extremely high. Do your research. If you're struggling with trading, head over to stackmode.net. Okay, the risk is going to be extremely high when it comes to day trading. Okay, so be aware of that. Okay, if you just lose your whole check in a minute, you probably did something wrong. Okay, you got to really analyze how much size you're putting down. There's calculations, entry criteria, time frames, and you have to really understand the overall direction of the market before you just start getting in and doing anything. And day trading is really going to require some advanced market knowledge, technical expertise, and your TA needs to be on point. Okay, so if your technical analysis is not as structured as it needs to be, you're not going to get to the type of profits that you want to be seeing when it comes to day trading. Okay, you have to really live on the charts. There was at least 2 years of me staying on the charts 16 hours a day. Okay, and I still look at the charts at least 2 to 8 hours a day, every single day. So if you want to be a day trader, you have to know how each and every single time frame correlates. You have to know how to read the higher time frame trends, and you have to really understand break and retest. That's really going to be a big thing that's going to help you keep your account safe. I'd say break and retest. Understand that price going in upwards direction is based off of resistances being broken, which you can logically put into hindsight, of the market, also known as all-time highs, is always going to be being chased to be broken. So say the Bitcoin height is going to be 100K, even if price dumps down to 50K, it's still going to try and get back up to that 100K one day and break it. That's just how trading is. Okay. So you have to really know the logistics of the market, understand it's a left to right chart, and do your information before you just start day trading. But as far as just putting some shares into a certain company, just know how to read support and resistance on like your daily time frame, and you can be a pretty decent investor. You don't even have to day trade in order to reach the type of income that you want to receive. But I understand that some people might be day trading due to FOMO too. I have a lot of day trade recaps too. You guys can see it's pretty easy to make hundreds, thousands of dollars within a day, but that's after you've struggled. That's after you've really humbled yourself. And that's after you've studied hundreds and hundreds and hundreds and hundreds of hours. Okay. So it's not something you're just going to jump into fresh and be successful in. Okay. A lot of times it's going to take information and knowledge. Okay. Because with day trading too, your emotional control has to be a lot higher. When it comes to long-term investing, you could really just hold for years and forget about it. Once again, there's a lot of people who are wealthy who don't even look at the chart. A lot of people who just had Bitcoin in their Coinbase account, on their USB drive, whatever, in their Phantom wallet, and just came back to it 10 years later and they were a millionaire. Okay. So you don't have to be the best trader of all time or the smartest person of all time to be a millionaire. You just have to really just invest and make the right decisions. So, but if you're going to be a day trader, make sure that you're at least ending the months positive. Okay. And you shouldn't be taking money from your business, money from your savings, and hauling that into your day trading account. Really have some discipline. Okay. And you should need to be earning your position size. So take the account from $1,000 to $2,500. Okay. Then take it to $5,000. Then take it to $10K. Then take it to $15K. Okay. Start it at $100. Take it to $500. Then take it to $750. Take your time. Okay. Grow your account, earn your position size. Don't take, even if you have M stashed, don't go take all of that and throw it into the market, especially when you're new. Because if you lose that, you're going to be distraught and you might do some emotional things. Okay. You might put down more size after a loss, trying to make it all back, thinking it's about to be the one play that's going to save your account. But that's the wrong mindset. That's why risk management is important. Okay. So instead of trading with 50% of your account in one trade and then taking another 50% of your account, so you lose that too, then your account is going on 2 trades. Okay. And that's completely your fault. But you could lose 5% at a time. Okay. 5%, 5%, 5%, 5%. Okay. And then say you take a win for 40%. You don't care about that 20% that you just lost. Okay. Because now you just won 40%. Now that 20% is canceled out and you're up 20%. Okay. So the math is in the risk. Okay. Whether being a day trader or long-term investor, understand that math is always going to be within how much risk that you have calculated, and as well as when you buy and when you exit. So taxes and transaction costs. So long-term investing, like we talked about a couple of slides ago, it's going to go ahead and give you lower taxes and lower fees. There's going to be long-term tax benefits for holding a trade for at least 1 year. And you only pay tax when you sell. Okay. And that's going to be realized gains. And if you hold an asset for over 1 year, you pay the lower long-term capital gain tax rate, which saves you money. Okay. So fewer trades equals lower taxes and fees, which could definitely eat out your profit. So future traders, don't just be spamming buy and sell instantly, because a lot of the time the fees are going to go ahead and cancel out the profit that you're scalping. And you shouldn't be trading like that. Trading is not a game. Okay. If you want to just give your money away to profitable people, it is called trading. That's fine. But all the market is people getting rewarded for being disciplined and patient. That's strictly all it is. And if you're getting your money robbed, or if you're not being consistent, that just shows you who you are as your person. So you could either change or continue to be the same. So day trading can be a little tax inefficient. You can still make some great income though. And profits are taxed as short-term capital gains. And these are trades that are held for less than 1 year. And they're equivalent to much higher ordinary income tax rates. So high volume of trades per month, per year, per day, you're going to be subject to just higher taxes and commission friction. Okay. So for almost everyone, both, okay, can be a strong option. But if you're just someone who has a family, has a lot going on, has a big business, you can't really stress about the charts. I really recommend just long-term investing. Okay, you could still make millions of dollars, achieve your goals, and get to where you want to be by just buying shares. Okay, you can buy shares, not have to worry about it. No time decay like options and futures, no leverage or margin you have to really worry about, especially if you're on a cash account. And you can really just stress-free, just invest, let your money sit, let it grow over time, put it in a company that you believe in, and yeah, just let your money work as a tool. Now, day trading. If you have time to study the market for, I'll say at least 6 months, like every single day, constantly, at least 16 to 18 hours a day, then yeah, you can go ahead and definitely day trade. Okay, but if you don't have that type of time commitment to put into the charts, then it's not worth it. So your screen time has to be consistent. You have to know how every single candlestick moves on every single time frame. Understand how the market structure is going to correlate as well too. And you got to be really quick when it comes to closing your trades. So day trades are going to be different. If you don't close at your certain levels when it's time to close and you get reversed on, you get emotional, that can turn into a spiral in itself. Okay, so you got to be really strong to day trade. Okay, and swing trade as well too. So take your time. Make sure you guys have tons of screen time on. Test it out in paper trading before you start putting any real money into the market, and make sure that your strategy works. Okay. Make sure that you guys are able to afford to lose the capital too. Don't trade with no rent money. Don't trade with no grocery money. Don't trade with no bill money. Don't do that. Okay, stay down until it's time. Put some income to the side. Once you have some income ready, okay, then it's time to start trading. Take care of yourself first. Okay, clear your debt. Okay, pay your credit cards off. Okay, make sure everything's good and structured, and then we trade. We don't come onto the markets desperate for income. Okay, get your life together first, and then you come onto the markets. The markets are for people who have their life together. Okay, so that's why you get rewarded for one, holding your trades for over a year, because you're not fiending to withdraw your money. When you have a business that's making you income that you can survive off of, you're not worried about the money that you have invested in your brokerage account. Okay, it's a lot of benefits for holding plays for over a year for a reason. Okay, they want to reward people for being financially structured. You can get rich if you're just financially structured. They make it really easy in this world. All the credit you guys can get. Okay, all, whether it be a business credit and or personal credit. Okay, all the loans you can get with certain things when it comes to real estate loans, and you can flip that into certain things. Okay, all the approvals you'll get. Okay, getting any truck that you want. Let's say you have a construction business. Okay, once you're a put together, financially stable individual, the world will treat you as such. Okay, so investing, it's really going to be the long game, and you're going to be the owner of your shares. You can sell them whenever you want. You're going to be in control of your portfolio. And day trading, it's going to be, I wouldn't say a short sprint. You could day trade until the end of time if you want, but understand that that mental exertion might get to you. So having money in ETFs, having money just put into something that's going to be making your money, so you can step away from day trading if you ever wanted to. All right, stay prayed up to God, keep grinding. Head over to Stackmode.net for all trading education. Peace.
So let's go and let's talk about central bank digital currencies, also known as CBDCs. Now, don't confuse this with cryptocurrency, because cryptocurrency is decentralized and doesn't have a ruler, and CBDCs are money ruled by the government. And think of this as a digital version of cash in your wallet, but with one massive difference: it's programmable. So that means that in theory, the issuer could track every single transaction you make, limit how much that you could save, or even decide what you're allowed to buy. And supporters claim that it is the upgrade our financial system needs to be faster and safer, but critics are calling it the end of the financial privacy embedded in us as humans forever. So we're looking at the future of convenience, or are we looking at the ultimate tool for our total control? Let's jump into it, inshallah. So what is a CBDC in the first place? CBDC stands for Central Bank Digital Currency. So imagine if the cash in your pocket turned into a computer code, but it was still worth exactly the same amount. That is the basic idea of a CBDC. And it's digital money issued directly by the country's central bank. Okay, it's not physical paper, and it doesn't come in coins. It exists only on computers or digital wallets. And unlike some cryptocurrencies that change value wildly, a CBDC is meant to be as safe as a dollar bill. Okay, so think of it like virtual cryptocurrency just created and ran by the government instead of it being on the peer-to-peer decentralized network. Okay, so the government's pretty much creating a currency in order to combat cryptocurrency coming out and its whole decentralized features. Okay, so we'll talk about the benefits. Let's jump into what it is and let's continue. Physical cash versus the CBDC. So we already use credit cards and apps like Cash App, PayPal, Venmo. So how is this going to be any different than things like that? So the commercial bank money that works today. So when you swipe a card, your bank promises to pay the store, okay? And it's an IOU between the banks, okay? And the CBDC, it's a direct liability of the central bank, and it's like handing someone digital cash directly without a middleman bank needing to promise the payment, okay? And as far as the speed, so regular bank transfers can take days, especially on the weekends. And also, when it comes to wire transfers, things like direct deposit when you're getting paid, things like that work on a time-based schedule, whether it be your direct deposit hit at 6 a.m. Some people have direct deposits hit at 6 p.m., okay? Some people don't have direct deposits that hit on weekends and have to wait for the following business day, such as a Monday or a Friday, etc., okay? But with CBDCs, payments and bank transfers are going to be instant. Okay, so they're creating a base in a way for people to instantly send money without having to use outside apps. Okay, so sending money today is like sending an email that goes through 3 different servers before actually arriving. And it has to all get approved too. Okay, if you decide to send money via wire transfer, it could definitely bounce. Okay, and sending a CBDC is like handing whoever you need to instant money, okay, or instant $20 bill, but doing it over the internet instantly instead of sending the $20 bill via the mail, waiting for the bank to sign off on it, and then sending the $20 bill to the person you want it to go to. That's how traditional banks work. So CBDCs really save a lot of time, make things a lot quicker, okay, and hopefully, inshallah, that'll bring a lot more control back into people's hands versus how we want to spend our money and when we need our money. So if CBDCs are out, what's the point of crypto, Chris? So if they're the same thing, and when they're not, and they both use digital technology, the real difference that comes in between them, okay? One is decentralized and one is not, okay? So they both use digital technology, okay? Sometimes the blockchain, but they're both different in the point of who controls it, okay? So cryptocurrency, Bitcoin, Solana, your XRPs, Ethereum, all decentralized. And the term decentralized means that it's not controlled by a centralized network, okay? When you decide to send Bitcoin to somebody, okay, it directly gets sent to their Bitcoin wallet, okay? No ifs, ands, or buts, okay? Peer-to-peer transaction system, also known as the decentralized system, okay? Then you're going to have the CBDC side, okay, which is going to be controlled, just like traditional banks, by that centralized bank fiat currency system, okay? But the price will be stable, okay? So $1 will equals $1. It's not going to be fluctuating as much. And as far as privacy concerns between the two, crypto is often anonymous, okay? You have to go into the blockchain in order to check certain transactions out, etc. But CBDCs allow the government to see the transactions in order to stop crime, any type of money laundering, or any type of fraudulent activities happening. Okay, so think of Bitcoin kind of like a digital gold that you own yourself. And CBDCs are going to be like digital dollars managed by the Federal Reserve. So one is for freedom and investment and speculative purposes, and the other is going to be for stability and spending. Okay, so one's purpose, okay, is going to be for speculative, freedom, and investment reasons. And the other purpose is going to be for stability, spending, and sending your money how you want within your centralized bank, okay, when you want, without having to use any type of external apps that you may potentially have to get approved for, especially when you already have your bank. Let's head over to the next slide. So let's talk about the 2 types of CBDCs. Not all CBDCs are for regular people, okay? There's going to be 2 main types. One, you're going to have the retail CBDC, okay? So this is going to be just for the day-to-day person. It's used for buying coffee, clothes, paying bills, and it really just acts like cash in an app, okay? And then you're going to have number 2, other side of it, you're going to have your wholesale CBDC. Okay, this is going to be for banks, and it helps huge banks send millions of dollars to each other instantly and safely, replacing the old slow systems. Okay, so retail is like the debit card in your wallet, and wholesale is like the armored truck that moves money between bank vaults. Okay, so really understanding the two different types of services and reasons why is going to help you make some future investment properties, especially when we start seeing banks implement CBDCs more and more due to the fact that they're trying to create some type of competitive edge against the whole cryptocurrency decentralized space. Okay, so why create a CBDC? Okay, governments aren't just building these for fun. Okay, one, it's for competition to create a space for them to still be profitable in the financial world, especially as cryptocurrency grows year after year after year after year, and people are starting to wake up to what's actually happening and how the currency works. Okay, and the efficiency of everything. So payments become instant and cheaper. So no more 3% credit card fees for shop owners, etc. And financial inclusion is going to come into play. So people who don't have bank accounts can still have a digital wallet on their phone to receive money safely. So that means you can still be able to do jobs and get paid exactly how you want. And in case you get declined by any app such as Cash App, Zelle, or anything like that, you're still going to be able to survive and pay your bills how you need to. And programmable money is what it is. So the government could send stimulus checks that expire if not spent, or can only be spent on food using CBDCs. Instead of having to get checks or use certain cards to spend money, CBDCs could be used to fund government programs to help out citizens. Okay, so during an emergency, the government could pretty much airdrop money directly to everyone's phone without having to mail paper checks and give everyone an essentially virtual card by using CBDCs. Okay, so we can start seeing things transfer away from traditional bank financial fiat currency system that we've been seeing for the past couple of decades into a whole new blockchain involved world. Okay, let's head over to the next slide. So let's talk about the risk and the concerns. So why are some people worried in the first place? So with great power comes great responsibility. Okay, so giving the government total control over digital money has risk, and it's going to be a privacy loss factor that comes into play. So cash is going to be private. Okay, if you buy a candy bar with a $5 bill, nobody knows where it came from even. With a CBDC, the issuer can technically trace every penny that you spend, which takes away people's privacy, which adds control back into people's lives. So if money is programmable, they could stop you from buying things. Okay, so that means that they could deny transactions, freeze certain things, just as a normal bank account can. But banks and credit unions have a little bit more separate control from just the straight up government centralized system directly. Okay, so cybersecurity reasons as well too. If the central system is hacked, the whole money system could freeze, or even if it goes down. So let's say a CBDC risk system is running on like a system like AWS. Okay, if AWS were to go ahead and shut down, that means people weren't going to be able to access their funds. Okay, so do you want convenience or privacy? Okay, both things are going to go ahead and have concerns, and a lot of factors are going to come into play. So deciding what you're using your money for and how you want to invest is going to change year after year after year. So make sure you guys are staying on top of things. And as far as compliance for even your own stores, even if you want to take CBDC currency, and we'll see how the things change over the next couple of years. So are CBDCs real yet? Answer is going to be yes. Okay, it's not just a theory. Many countries are already using and testing them. Okay, for the Bahamas example, using the sand dollar. So the Bahamas is the first country to launch a full CBDC. So people use it to pay across different islands using mobile phones. And then we got China. Okay, China using the digital yuan. And millions of people in China are already testing the eCNY. Okay, electronic CNY. Okay, it's just digital fiat currency for China to buy subway tickets, groceries, etc. And then we got US. We got the Project Hamilton. Okay, the Federal Reserve and MIT are researching how our digital dollar would work, but haven't launched one just yet. But the United States is working on things. Okay, so over 100 countries representing 95% of the world's GDP are currently exploring a CBDC. Okay, and this is going to be research done as of 2023, and we can start seeing a lot of things change, especially when it comes to government-funded projects, such as like food stamps, unemployment, or anything like that. Instead of people getting the money placed on certain cards or traditional bank account systems, a CBDC wallet could be used in order to have people spend money on that throughout the entire network. So monies came a long way. It came from seashells to gold coins, seasoning to paper bills, and now we got plastic cards, and now we can just send money digitally with numbers on the screen with our phone. And CBDCs seem to be the next logical step in a digital world realistically. So as you grow up, you gotta understand how money works, you gotta be able to adapt, and you gotta be ready to change how your asset classes are being moved and how your money is growing, especially as things get more expensive over time. Your money has to be working for you, okay? Keep that logical perspective. If the world is gonna get more expensive over time, that means that your money can never stop working. Especially when we have to do things like use the bathroom, sleep, etc. You have to be getting money while you're doing that stuff. Okay, if you want to be competitive in this world, you got to be getting money at all times. In your sleep, while you're awake, while you're getting money, you should be getting money, and it should be that serious, inshallah. Okay, so CBDCs offer speed and safety, but we must come to terms with the fact that you're going to be losing respect of privacy, but you are going to be getting a lot of convenience as well too. Okay, no more long paperwork, waiting for cards and stuff like that. And a lot of that stuff can be frustrating. Okay, just instant funds that come on a wallet, and we'll really see how it plays out for the future. So stay prayed up to God, keep grinding, and head over to Stackmode.net for all trading education. Catch you guys in the next one. Peace.
What's going on, class? Today we're going to be talking about the number one investing mistake that all beginners make. Let's jump into it. It's not about what you buy, it's about when you sell. And stop thinking that everything is quick and instantaneous. You're not going to get rich overnight. You're going to have to hold these positions for a long time in order to actually build your portfolio. So be ready to be in the game for decades and years. And if you think that market's a casino, or you think you're about to come in, get rich quick and get out, you're not going to make it. I'm just going to keep it simple like that. But if you're someone who's ready to wake up, pray, be disciplined, be consistent, and ready to get to the next level and improve each and every single day, then the sky's going to be for you. Let's go. So 1, the emotional market timing. The belief that you can consistently buy at the lowest point and sell at the highest point. Not true, okay? Sometimes you're not always going to catch the lowest of the lows. You're not going to always be able to sell at the all-time highs. People obsessed with catching the ultimate tops and bottoms normally don't typically make money. Okay, they'll go through a panic cycle. So buying high, for example, investing after a big market run up, say Bitcoin, for example, people like to consistently buy all-time highs. Once they start seeing Bitcoin being posted all over the internet and stuff like that, it's at all-time highs, then people want to go ahead and invest in. And then they're going to go ahead and get pulled back on due to the fact that instead of investing at a certain low and catching the sweep up, they just decided to buy all-time highs due to hype. So FOMO is going to be the biggest mistake that certain people make when it comes to investing. Okay, being emotional and FOMO. FOMO stands for fear of missing out. Okay, so thinking that, oh, I'm not going to get money in this trade if I don't hop in right now. Like, relax. Most things go down just to come back up. Okay, understand that when market decides to go down, all it is people selling. People have gotten in from way from the beginning of the stocks opening or tokens opening. So people, of course, are going to take profit eventually as it goes up. Okay, and don't sell low. Okay, out of fear. Selling everything during a market crash or just a dip because the news tells you the sky is falling. Okay, you should have your stop losses in place, which is going to be an automatic order that's going to close your trade at specific areas in case your trade goes to an area you don't want it to. But otherwise, you can't just sell based off of just certain dips and stuff like that. Have a long-term vision, have a long-term plan. And a lot of you end up negative in P&L too, profit and loss at the end of the year due to the fact that you guys close your trades too early. If you don't give your trade room to breathe and really do its thing, you're going to consistently just keep selling for a loss over and over again, causing you to be unprofitable. And if you guys have noticed that, oh man, after market dipped down, a couple of days or weeks later, you'll notice that prices even past where it dipped from where it was high at before. Okay, so you have to realize that just by holding a little bit longer and being emotionally resilient through drawdowns, you could actually make a lot of money. And lock-in losses and missing inevitable recovery. Okay, so you're locking in losses every time you just decide to sell early. Every time you sell early outside of your plan or sell early thinking, oh man, I don't want to lose money, or you just see a little bit of drawdown, you sell early, you're locking in losses. You're not locking in gains at all. You're locking in losses. And that's not what we want to be doing. Okay. And make sure we're not chasing the hype. Okay. So when it comes to stock picking or crypto token picking, believe it, you can find the next Amazon or crypto based on a tip from a friend or social media may not be the most ideal answer. Make sure you guys are doing deep financial fundamental analysis. Make sure whatever you're investing in is profitable. Okay, this way other people are going to go ahead and invest into it as well too. Make sure it's having a future, and make sure it's really making a way for people to have an easier time within life. Okay, because a lot of the times those companies and those tokens, what they're going to do is go ahead and put money in people's pockets since they're advancing the future. And putting 90% of your money into one risky asset can be really, really bad too. Make sure you guys diversify a little bit. I recommend you guys do between like 1 to 3 long-term plays. Okay, so even if you're a day trader, I recommend you guys still trade between 1 to 3 long-term trades. And the reality of it all, active traders consistently underperform the broad market index over the long term. So the devastating costs, missing the best days. So when market returns from 1980 to the 2020s, for example, the average return of the S&P 500, which is just the index of the top 500 United States companies, okay, just put into one big conglomerate called the S&P 500. You can decide to invest in that. And the average annual return of the S&P 500 is 10.7%. Okay, let's say investor A, for example, they didn't close, they held due drawdowns, they knew that market was going to fluctuate up and down, but eventually they know that the whole goal of the market, cryptocurrency or stock market, is for the price to go in an upwards direction. Because why? For the stock market, when people release an IPO, you have to understand that people are releasing the stock market in order for them to gain more funding for their company. Okay, so that's why we're buying shares, to be participants of that. So they want their stock to go in an upwards direction. Same thing with crypto tokens. There's people putting in tons of work behind these projects, and they want their crypto token to go up because I'm sure they have large reserve as well too. So investor B, let's say investor B missed the best 10 days, okay, and their annual return plummets to 4.9%. And investor C missed the best 30 days, and their annual return drops to 1.5%. The best days usually follow the worst days. And if you're out the market, you miss the recovery. Okay, so the best days usually follow the worst days. So what that usually means is after market dips, okay, you want to go ahead and try and catch the sweep at the low and catch the sweep back up. Okay, even if you don't catch the most bottom entry, if you start seeing market make a nice sweep upwards, especially towards an area of resistance, say all-time highs, because market's goal is always going to be trying to break all-time highs. Whether it be a stocks or crypto, market is always going to be trying to break all-time highs. So always know that. Put that into your logic. So the fact that you know it's always going to try to break all-time highs, any low, okay, that happens, especially after that, and market starts going in an upwards direction, that'll be a great time to buy. And that's the best days. Okay, when you catch the best days and you're able to catch nice sweeps consistently, you're going to be able to make a large percentage gain back. Okay, and taxes as well too can come into play. Frequent selling means you're paying short-term capital gains tax, which is taxed at your higher ordinary income rate. Okay, so that's also why there's going to be something called long-term tax gains. So I recommend